Very good morning. I will quickly go through whatever we have discussed till now in section 54, and then we will proceed further with respect to our discussion for other sections relating to exemption. Yesterday I explained you that if there is a long-term capital gain on transfer of residential house property, then SSE is having two options. Number one, pay tax at the rate of 20% on such long-term capital gain by applying the provisions of section 112. And the second option is to claim exemption under section 54. Exemption can be claimed subject to fulfillment of certain conditions. Number one condition, SSE should be either individual or HUF. In other words, person other than individual HUF, they are not eligible to claim any exemption. Number two condition, the capital asset transferred should be residential house property. Capital asset transferred should be residential house property. If any other asset is transferred, then section 54 is not applicable. Number three, the nature of capital asset transferred should be long-term asset. In other words, there should be long-term gain. If the asset is short-term and the gain is short-term, in that case, you are not eligible to claim any exemption. You have to pay tax on short-term gain. For claiming exemption under section 54, SSE has to either purchase the new residential house property or he has to construct a new residential house property. There is some time limit given for purchase and construction of new residential house property. If SSE wants to purchase the new residential house property for the purpose of claiming exemption, then he has to purchase the new residential house property 1 year backward or 2 year forward from the date of transfer. From the date of transfer, he has to purchase new residential house property 1 year backward or 2 year forward period. Whereas if SSE intends to construct the residential house property, then construction should be completed within 3 years from the date of transfer. Construction should be completed within 3 years from the date of transfer. Construction can start anytime. Construction can start even before selling the old property, but the construction should be completed within a span of 3 years from the date of transfer. Here we try to understand that definitely there is a period of 1 year backward, 2 year forward with respect to purchase of property and 3 year forward with respect to construction of property. But for the previous year 2021 and the corresponding assessment year 21-22, SSE is expected to file his income tax return on 31st July 21. So the point is, while he is filing his income tax return, whether he would pay the tax on capital gain or whether he would claim the exemption. So government says you can claim the exemption in two circumstances. Circumstance one, if you have actually acquired the property or constructed the property up to the due date of filing return, or if you have neither purchased the property nor constructed the property, in that case also we will give you exemption because we have given you a 1 year backward, 2 year forward period for purchase and 3 year forward period for construction of property. We will give you exemption, but the condition is before the due date of filing return, you have to go to a nationalized bank, open a capital gain deposit account and deposit money in that account. Thereafter, based on the actual amount invested in the property up to the due date of filing return plus amount deposited in the capital gain account, will take both the amounts together. Number one, amount actually invested in the property up to the due date of filing return plus amount deposited in the capital gain account up to the due date of filing return. These both amounts will be taken together and exemption will be calculated based on this combined amount. Exemption format is very simple. Exemption under section 54 is lower of following two amounts. This is what is the format which we had discussed yesterday. Exemption under section 54 is lower of following two amounts. Number one, gross long-term capital gain, that is amount of capital gain. Number two, amount utilized for acquiring residential house property up to the due to the filing return plus amount deposited in the capital gain account up to the due to the filing return. This is the way, this is the manner in which exemption will be calculated. Thereafter, we understood that if SSC has claimed exemption by depositing money in capital gain account, then we are expecting the SSC to withdraw that money from capital gain account and utilize that money for the purpose of either acquisition or construction of new residential house property. If he is unable to utilize that money up within a period of 3 years from the date of transfer, either for acquisition or for construction, then on expiry of period of 3 years, unutilized amount will become taxable. On expiry of period of 3 years, unutilized amount will become taxable. But unutilized amount does not mean the amount which is lying in your bank account. Yesterday, I took an example saying that you had deposited 60 lakhs in your capital gain account. 60 lakh was deposited in your capital gain account, out of which you utilized only 30 lakhs within a period of 3 years. So, you have utilized 30 lakhs. What is lying in your account is balance 30 lakhs. But this 30 lakhs will not become taxable. For finding out, this 30 lakhs is definitely an unutilized amount. But it is not necessary that this unutilized amount will become taxable. For finding out the taxable amount out of the unutilized amount, we have to ascertain for how much amount we had given you exemption in the past. So this format, 4-line format is required to be followed for finding out the taxable amount out of the unutilized amount. First point is how much amount was deposited in the capital gain account, that is 60 lakhs. In our example, it was 60 lakhs. Out of that, we had given him exemption for 78,93,000. But out of the exemption of 78,93,000, 30 lakhs exemption was given because he had actually invested money in buying the plot of land. So, the balance exemption, that is 78,93 minus 30, that is 48,93,000. That much amount of exemption was given for depositing money in the capital gain account. So that much amount of exemption was given for depositing money in capital gain account. So you have actually deposited 60 lakhs in the capital gain account, but exemption granted to you out of that 60 lakhs is only 48,93,000. Now from this I need to deduct unutilized amount. So from 48,93,000 I will deduct 30 lakhs and the balance is 18,93,000. This 18,93,000 is the taxable amount out of the unutilized amount. Unutilized amount is actually 30 lakhs, but 30 lakhs is not going to be taxed. Only 18,93,000 will be taxed. This is very important aspect of our discussion. This we have discussed yesterday. Now I am on to the next part, last point of this section 54. Saying that whatever property you have acquired, either you have purchased or you have constructed, government says there is a lock-in period of 3 years on that property. In other words, from the date of acquisition or from the date of completion of construction, within a span of 3 years, within a time span of 3 years, you cannot sell the property. If you have sold the property, what is the consequence? Your exemption which was granted to you earlier will be withdrawn, plus there will be a capital gain on transfer of new property. These two consequences will be combined in a computed in a combined manner. This calculation will not be made separately, it will be a combined calculation. So SSC cannot sell the property within 3 years from the date of acquisition or date of completion of construction. If SSC has sold the property within 3 years, he has to face two consequences. Number one, capital gain will arise on transfer of new property. And number two, whatever exemption was granted earlier, that exemption will be withdrawn. And this calculation will be done in a combined manner. This calculation will be done in a combined manner, meaning thereby you have to calculate capital gain on transfer of new property. First of all, you calculate capital gain on transfer of new property. So whatever is the full value of consideration for new property that you write in our example, it was 1 crore 10 lakh. Expense transfer was 2 lakh. Net consideration was 1 crore 8 lakhs. Now, generally from this net consideration, we deduct the amount of cost of acquisition to arrive at the amount of capital gains. But here, we are not going to deduct the entire amount of cost of acquisition. From this cost of acquisition of new property, I would deduct the amount of long-term capital gain which was exempted to me earlier. So, the cost of acquisition of my new property is 60 lakhs. Yesterday, few people had confusion with respect to how this 60 lakhs is arrived. 30 lakhs was spent for purchasing the land and 60 lakhs was deposited in the capital gain account. Out of that 60 lakhs, only 30 lakhs was utilized for construction of property. So a property is now worth 60 lakhs. 30 lakhs is the land of cost of land and 30 lakhs is the construction cost. So combined cost is 60 lakhs. So that 60 lakhs is the amount of money invested in property. From this amount, I should deduct the long-term capital gain exempted to you earlier. In our example, long-term capital gain exempted was 78 lakh 93,000. Out of that 78 lakh 93,000, an amount of 18 lakh 93,000 is already taxed to you as part of unutilized amount. So now we are left with how much exemption? Only 60 lakhs exemption. That 60 lakhs exemption will be withdrawn. So whatever is the amount of exemption claimed earlier, that will be withdrawn. So what is the balance cost is 0. Every time you may not get the balance cost as 0. In certain cases, you will get some amount in the balance cost. So the moment you deduct this amount, so instead of cost of acquisition, we are expected to deduct cost of acquisition minus the amount of exemption claimed earlier. So we will take the deduction for reduced cost of acquisition. Reduced cost of acquisition will be allowed as deduction from net consideration. Thereafter, we will get the amount of capital gain. This capital gain amount, which is 1 crore 8 lakhs, is nothing but it is consisting of two things. Number one, gain on transfer of new property, and number two, amount of exemption which was granted to you earlier is withdrawn. So that is a combination of two things. This is what we had discussed yesterday. Till this point we have covered, and I had asked you to refer to this section 54 at home. I am sure you might have referred. You might have also come across 2-3 points which we are yet to discuss. So now we'll refer to this and we'll discuss those 2-3 points. Section 54 we are on, the most important section. We have devoted maximum time to this. Once we complete this, thereafter all other sections will be done at a rapid pace. Who can claim exemption in section 54? Individual and HUF can claim exemption. Nature of capital asset transferred should be long term. Which capital asset is transferred? A residential house property is transferred. Residential house property whose income is taxable under the IFHP, that property is transferred. Which asset taxpayer is expected to acquire for claiming the benefit of exemption? SSC is expected to acquire only residential house property. That too only one residential house property. Only one residential house property he can acquire. In other words, for example, if SSC is selling, say, a residential house property 1, this is sold. There is a long-term capital gain on this. You want to claim exemption. Then you acquire residential house property number 2. So how many properties are sold? One property is sold. How many properties are acquired? One property is acquired. This is the first example. Second possibility is you are having two residential house property. Residential house property 1 and residential house property 2. Residential house property 1, residential house property 2. You have sold both these house properties. Both are sold. There is a long-term capital gain and you have an intention of claiming the exemption. Whatever capital gain which has arisen on transfer of residential house property 1 and residential house property 2, can you claim exemption for both? Yes, provided you acquire two more properties. So if you acquire residential house property 3 and residential house property 4, in that case 1 to 1 you can claim exemption. One property is sold, against that another property is acquired, you can claim exemption for both. In this manner you can claim exemption. Third example I am giving you. Say for example you are having a residential house property 1. This is a very big property. This property is sold. There is a long term capital gain and you intend to claim exemption on this long term capital gain. For this you have acquired residential house property 2 and residential house property 3. So basically you sold one bigger property and you acquired two smaller properties. Can you claim exemption? You can claim exemption for only one property, not for both. So whatever amount is spent for either acquiring residential house property 2 or residential house property 3 can be claimed as exemption. Investment made in both the houses cannot be claimed as exemption because provision says SSE should acquire only one residential house property. He should acquire only one residential house property. That too, he should acquire this in India. So first part, very important, is SSE should acquire only one residential house property. Only one residential house property. As a consequence of this word only one, here you can claim exemption. But exemption can be claimed. Exemption is allowed for only one residential house property. So you cannot claim exemption for both. Either you claim exemption for residential house property 1 or you claim exemption for residential house property 2. You cannot claim exemption for both. So, which property you would like to claim exemption? Would you like to take into account residential house property 2 or 3 for the purpose of claiming exemption? You should actually select the property whose value is higher, because in that case you will get more exemption. Say for example, cost of acquisition here is 20 lakhs and cost of acquisition here it is 30 lakhs. So in that case, you should select residential house property 3. So amount invested to the tune of 30 lakhs can be claimed as exemption, subject to the condition that you have that much amount of capital gain. Subject to the condition that you should have that much amount of capital gain. For example, your capital gain is 40 lakhs. Your long-term capital gain is 40 lakhs. So in case, if you want to claim exemption for residential house property 2, then out of 40 lakhs you can claim exemption for only 20 lakhs, balance 20 lakhs will become taxable. Whereas if you claim exemption for residential house property 3, then you can claim exemption for 30 lakhs and balance 10 lakhs will become taxable. So we are not going to give you exemption for both the new properties acquired, but we'll give you exemption only for one property. You have to decide which property. There was no such condition before 5-6 years. This condition was inserted and people were facing undue hardship because of this condition. The reason is, sometimes you may see that people are staying in a joint family. People are staying in a joint family. But say for example, after 2 sons, 3 sons are getting married, then sometimes it is difficult for them to stay in a joint family. In that case, they sell off their bigger property and they acquire smaller properties. At such point of time, if you charge capital gain tax to the SSE, he will face undue hardship, and the purpose with which the section was made, that basic purpose itself will be defeated. Basic purpose of creating a section will be defeated. Therefore, recently in the last year itself, that in budget 2019, government has come out with a relief provision. In this case, section 54, government has inserted one provision which is providing some relief in such situation. Now, what is that relief? The relief is, government says if the amount of long-term capital gain, in case, if the amount of long-term capital gain does not exceed 2 crores, if the amount of long-term capital gain in your case does not exceed 2 crores, in that case, you can claim exemption for both the properties. You can claim exemption for both the properties, and such benefit is available to you only once in your lifetime. Throughout your life, you can claim exemption for more than one property only once in lifetime. So this once in a lifetime relief was granted in budget 2019. So we'll discuss that. So now, since I have told you that provision, you might feel that no sir, in this case also you can claim exemption for both the property. The answer is correct. In this case, you can claim exemption for both the property, provided this is first time and the last time he is claiming exemption. So let me change the amount for you, saying that the long-term capital gain here is 3 crores. 3 crores. And residential house property 2, the cost acquisition is say 2 crores. Residential house property 3, cost acquisition is 1.5 crores. So can he claim exemption for both the properties? Answer is no, because the amount of capital gain has exceeded 2 crores. It has exceeded 2 crores. What the new provision says? This new provision was introduced as an amendment in budget 2019. It says if the amount of long-term capital gain which has arisen to you on transfer of old property, if that long-term capital gain does not exceed 2 crores, then we will allow you exemption for acquiring multiple properties, provided such kind of benefit will be available only once in a lifetime. It will be available only once in a lifetime. Now let us move on to this provision and let us try to read what it says. SSC should acquire only one residential house property. In the bracket I have written here, 2 residential houses in India can be acquired at the option of the SSC where the capital gain do not exceed 2 crores. And this option is available once in a lifetime. This is explained in detail in note number 6. So just below the section you have the note. In that it is explained in detail. SSC is individual HCF. He wants to claim exemption for acquiring residential house property. So he can claim exemption for acquiring how many houses in India? That is a question. So where the amount of capital gain exceeds, 2 crores, SSC can claim exemption for purchase construction of only one residential house in India. Second point says where the amount of capital gain does not exceed 2 crores, SSC may at his option claim exemption for purchase or construction of 2 residential houses in India. This benefit will be available to the SSC only once in a lifetime. Yes. Now listen to me carefully. I am explaining you one more point. Few years back, I am talking about around 5-6 years back, one SSC was an individual was settled in USA, whereas his parents were there in India, and his parents died, and that individual sold their properties. So that individual inherited the property from his father and he sold the property in India. He was settled in USA, so he decided to buy the property in US because that individual did not have any plans to come back to India. So he sold his father's property which was inherited by him in India. He sold that property there was a long-term capital gain to that individual. Instead of paying tax at 20%, he opted to claim the exemption under section 54. And you know that for claiming exemption under section 54, you have to acquire a property. So he acquired property in USA and he claimed the exemption. His case was picked up for scrutiny and the income tax officer denied the exemption, saying that you have to acquire property in India. If you want the exemption under section 54F, you have to acquire property in India. I am denying you exemption. You can't claim exemption if you acquire the property outside India. That is what income tax officer claimed. So that individual fought a case against the income tax department and decision was given by court saying that nowhere in section 54 they have mentioned that new property should be acquired in India, and the decision was given in the favor of SSE. Government did not like this decision. Therefore, government came out with an amendment saying that now onwards we will give you exemption in section 54 only if you are acquiring new property in India. In other words, now if you acquire property outside India, you are not eligible to claim any exemption. So here we have written only one residential house property in India. In India. If you acquire property outside India, no exemption to you. Next point is, what is the time limit for acquiring the new asset? For purchase, it is 1 year backward, 2 year forward. For construction, it is 3 year forward. This time limit of 1 year backward, 2 year forward should be recognized. From which date? It should be recognized from the date of transfer. How much is the amount of exemption? Here I have simply written investment in new asset or capital gain, but I give you example in detail. Exemption is lower of following two amounts. Number one, gross long-term capital gain. Number two, amount invested in the property up to the due date of filing return plus amount deposited in the capital gain account up to the due date of filing return. Take the addition of both the amounts, compare it with amount one, whichever is lower will be the amount of exemption. Under what circumstance exemption will be withdrawn in the subsequent year? If the new property is transferred within a period of 3 years from the date of acquisition or the date of completion of construction, then whatever exemption was granted to you, that exemption will be withdrawn. Taxability on withdrawal of exemption is as per note number 3. I have already explained you, I am just reading it. Capital gain will arise on transfer of new asset within the lock-in period. Within the lock-in period means within a period of 3 years. If you transfer the new property, capital gain will arise. For computing such capital gain, the cost of new asset shall be reduced by the amount of capital gain exempted under this section earlier. So while computing capital gain on transfer of new property, what you have to do? From the cost of acquisition of new property, you have to deduct the amount of capital gain which was exempted to you in respect of old property. This is the manner in which you have to calculate capital gain. Capital gain arising on transfer of new property can be long-term capital gain or short-term capital gain depending upon the period of holding of new asset. If you have holded new asset for a less than equal to 2 years period, then you have to calculate short-term gain. If you are holding the asset for beyond a 2 years period, then it is a long-term gain. On the other hand, these two lines, this I will not read right now. I will read when we move on to section 54D. So right now I am leaving this aside. So note number 3, for the timing you can say that it is over. Note number 6 is already over. Whether scheme of deposit is applicable for claiming exemption in section 54? Yes, scheme of deposit is applicable. Meaning thereby, if you are unable to actually acquire the property up to the due date of filing return, what you have to do? You have to open capital gain deposit account, deposit money in that account within the due date of filing return and claim the exemption based on the amount deposited in the capital gain account. But very important point to be noted is, if you have deposited any money in the capital gain account after the due date of filing return, then that amount should not be taken into account for the purpose of computation of exemption under section 54. Now friends, let us go through this very quickly. Scheme of deposit. If the new asset is not acquired up to the due date of submission of return of income, that is income tax return, then the taxpayer SSE will have to deposit the money in capital gain deposit account scheme with a nationalized bank. On the basis of actual investment and the amount deposited in the deposit account, exemption will be granted to the taxpayer. Taxpayer should acquire new asset by withdrawing money from the deposit account within the time limit prescribed. Amount lying unutilized in the capital gain account scheme will become chargeable to tax in the previous year in which the specified time limit expires. Specified time limit is 3 years from the date of transfer. The year in which this 3 years period expires, in that year, unutilized amount will be made taxable to you. Next part in the bracket, whatever I have written, I am not reading, that is connected to section 54F. Here we are saying that unutilized amount will become taxable as short-term gain, long-term gain depending upon the original capital gain. In our case in section 54, the capital gain original is definitely a long-term capital gain. So unutilized amount will be taxed as long-term capital gain only. Why have I written short-term gain here now? Because in other sections you have short-term gain also. This note number 4 for 5 different sections. I cannot write note 5 times. So I have combined this note for all the situations. Thereafter, unutilized money can be withdrawn by the taxpayer. Once the tax is levied on the expiry of period of 3 years, whatever amount is lying unutilized in your bank account, that amount will be taxed. And once tax is levied, you can withdraw that amount from the bank account. See, once you have deposited money in the capital gain account, you are not allowed to withdraw money. You are not allowed to transfer money from one account to another. If you want money from that capital gain account, you have to request the bank, and bank will give you the check in the name of person whose property you are buying. Say for example, new property which you are buying, you have done a booking with the builder. In that case, you have to provide the name of the builder to the bank, and bank will give you the demand draft in the name of that builder. In other words, once you deposit money in capital gain account, you will not be allowed to withdraw the money from the account. On the expiry of 3 years, once the amount has become taxable to you, thereafter only you can withdraw the amount from the account. Let's now move on to the last part, that is CBDT circular which was issued in 1996. It says that in the event of death of an individual, before the stipulated period, means 2 year backward for purchase of property and 2 year forward for purchase of property and 3 years forward for construction of property. The time limit is given. During that time, your money might be lying in your capital gain deposit account. During that period, if that individual dies, then what will happen? What about that money which is lying in the account? For that, CBDT has issued circular number 743 long back in the 1996. It says in the event of death of individual before the stipulated period, unutilized amount is not chargeable to tax in the hands of legal heir of the deceased individual. So if an individual dies, then whatever amount is lying unutilized in the capital gain account will now belong to the legal heir, and no tax will be levied in his hands. He can withdraw the money without acquiring the new property. So now government is not expecting him to acquire the new property. He can withdraw the money and tax will not be levied. Such unutilized amount is not an income, but it is a part of estate devolving upon them. Part of estate devolving upon them means when a person dies, all his properties will be received by the legal heir. So whatever property is received by legal heir, we say that it is a estate developing upon the estate devolving upon the legal heir. Estate devolving upon the legal heir. So legal heir is receiving all the property of the deceased person. In that property, one thing is amount lying in the capital gain deposit account. So now he will withdraw the money from that account and tax will not be levied in the hands of legal heir. So with this we have completed note number 4 also. Yes, is that clear? Do you have any doubts in note number 4? Yes or no? Please respond. Anyone of you having doubt, or shall I proceed further? So with this, we have completed the discussion of section 54 entirely. Now we can proceed with respect to practical question on section 54. Section 54, our discussion is over. A very much comprehensive question on section 54, that is question number 15, covering all the permutation combination. Let us go through the question very quickly. R owns a residential house which was purchased by him in 1996 for 3 lakhs. So 3 lakhs is the cost acquisition, 1996 is the year of acquisition. Definitely this is acquired prior to 1st April 2001. Therefore, the examiner should give you fair market value of this property on 1st April 2001 in the question. Next sentence he says fair market value of the property is 1st April 2001 and this is 12 lakh 50. So how much amount you would consider as your cost of acquisition for computing capital gain would be definitely 12 lakh 50,000. This house is sold by him on 16 July 20 for a consideration of 45 lakhs. So 45 lakhs should be ideally considered as full value of consideration. Further it says the value adopted by the stamp valuation authority for collecting stamp duty is 50 lakhs. Here comes the role of section 50C. Here comes the role of section 50C. Now you tell me, what amount should be considered as full value of consideration for the purpose of computation of capital gain? Should I consider 45 lakhs or should I consider 50 lakhs? Yes? $50 lakhs. Only Sarvana says 45 lakhs. All others are saying 50 lakhs. Let me change the question slightly. I am just changing. You should not change in the textbook. I am just changing the question slightly. You should not change in the textbook. Sarvana, your understanding is slightly incorrect. You refer to that flowchart given for section 50C. Now, what if the stamp duty value instead of 50 lakhs, it is 47 lakhs instead of 50 lakhs? Don't change the amount in the textbook. I am just changing only for a better understanding. Instead of 50 lakhs, if this value is 47 lakhs, then what? Yes? In that case, 45 lakhs will be taken as full value of consideration. No. Sarvana, your understanding is exactly opposite. Your understanding is exactly opposite. If your stamp duty value is more than 110% of agreement value, then stamp duty value will be considered as full value of consideration. What is the agreement value? 45 lakhs. Take out 110% of 45 lakhs, that is 49 lakh 50,000. If your stamp duty value is more than 49 lakh 50,000, then stamp duty value will be considered as full value of consideration. In our example, stamp duty value is 50 lakhs. It is more than 49 lakh 50,000. So 50 lakhs will be taken to be full value of consideration. What if the stamp duty value is less than 49 lakh 50,000? Second example I took, in which I said that stamp duty value is 47 lakhs. Then in that case, your actual selling price. In that case, your actual selling price will be considered as full value of consideration. Your actual selling price is 45 lakhs. Please understand, either your agreement value can become the full value of consideration or your stamp duty value can become the full value of consideration. Your 110% is only for the purpose of comparison. 110% is only for the purpose of comparison. Sarvana, have you understood? If the stamp duty value is more than 49 lakh 50, if it is 50 lakhs, then 50 lakhs will be taken as full value of consideration. If stamp duty value is less than equal to 49 lakh 50, in that case, if stamp duty value is 47 lakhs, then 47 lakhs will not be considered as full value of consideration. Your actual selling price 45 lakhs will be considered as full value of consideration. Yes, is that very, very clear to each one of you? Shall I proceed? Yes, so let us proceed further. Further, it says brokerage and other expenses on the transfer were 15,000. So, how much we are going to consider as full value of consideration? 50 lakhs. And brokerage will deduct 15,000. So, net consideration will be 49 lakh 85,000. The due date of furnishing the return of income is 31st July 21. Due date of furnishing return is 31st July 21. That is implied. Compute the capital gain for the assessment year 21-22 if point A, point B, point C, point D. So now they are asking you 4 different questions. You have to give 4 different answers. The paragraph, the information given in the paragraph is common for all the situation. Information given in the paragraph is common for all the situation. Thereafter, we have 4 different situations A, B, C, D. In other words, for calculation of capital gain, there is a common information. But for the purpose of computation of exemption under section 54, you have 4 different situations A, B, C, D. So forget about that, what is written in A, B, C, D situation. You tell me what is the amount of capital gain. You just calculate and give me the amount of capital gain. Yes, 50 lakhs is your full value of consideration. Expense on transfer is 15,000. Net consideration is how much? 49 lakhs 85,000. Yes. From that you deduct index cost of acquisition. Your cost of acquisition, actual cost of acquisition is 3 lakhs. Fair market value on 1st April 2001 is 12 lakh 50. So 12 lakh 50 will be taken into account for the purpose of computation of capital gain. So 12 lakh 50 into 301 divided by 100, you will get index cost of acquisition. Deduct that index cost of acquisition from the amount of net consideration, which is 49 lakh 85,000. Your amount of long-term capital gain. I have got answer from 3 different persons, but the answer is same. 12 lakh 22,500. 12 lakh 22,500. $50 lakh will be considered as full value of consideration. Expense on transfer is 15,000. Net consideration is 49 lakh 85,000. Don't take into account this because this is the last year solution. So let us change this. This should be 301. That is the index number of 2021. Divided by 100. That is the index number of 2001-2. Yes, tell me, what is the amount of index cost acquisition? 37 lakh 62,500. 37 lakhs 62,500. This is the amount of index cost of acquisition. Index cost of improvement is 0. Now you deduct 37 lakh 62,500 from 49 lakh 85,000. What is your gross long term capital gain? 12 lakhs 25,500. Is that correct? 12 lakhs 25,500. 12,25,500. Okay. Every one of you have got the answer 12,25,500 or 12,22,500. How much it is? 12 lakhs 22,500. Okay. 12 lakhs 22,500. Till this point your solution is same. Till this point, up to the point of gross long term capital gain, your solution remains the same, that is 12,22,500. Now we will refer those 4 different situations and situation wise we will make the solution. Can you tell me what should be the period of holding from 1996 up to which date? Up to 15th July 20. 1 day prior to the date of transfer, that is up to 15th July 20. I told you this solution is last year's solution. So I am making changes here. I will send you the revised solution in which amounts will be changed. Okay. Now let's move on to the first situation. Situation A. He is investing 10 lakh for purchase of new house on 14th May 21. He is investing 10 lakh for purchase of new house on 14th May 21. 14th May 21 means, can I say he has purchased a new house in next year itself? That too in the month of May. That too before the due date of filing return. So this 10 lakh will be eligible for exemption. He has sold the property. Date of transfer of original property is 16th July 2020. From this date, time limit for acquiring new properties 15th July 2022. He has actually purchased the new property on 14th May 21. What is gross long term capital gain? 12 lakh 22,500. Are you writing this solution now? You have the format of solution in the book. Which page number? Page number 228 in your textbook, 228, 229. You have the format. So you should write the solution. Here I will write 12 lakhs 22,500. So from 12 lakh 22,500 I would deduct 10 lakhs as exemption. So balance will be 2 lakhs 22,500. 2 lakhs 22,500. Yes, have you understood first situation, situation A? Yes or no? Shall I proceed? Please respond. Okay. Now let's move on to second situation. Situation B. Let's see what it says. He purchased a piece of land for construction of house on 21st October 20. 21st October 20 is within your previous year 2021 itself. So he has already purchased the plot of land for construction of house for 7 lakh 50 and deposited 4 lakh 50 in the capital gain deposit scheme on 15th June 21. Is it eligible for computing exemption? Can you deposit money in the capital gain account on 15 June 21? Yes, because your due date of filing return is 31st July 21. Before that you have deposited, that amount should be taken into account for the purpose of computation of exemption. And it says a further sum of rupees 1 lakh 80 is deposited on 30th June 22. By mistake, don't read this as 30th June 21. Your due date of filing return is 31st July 21 and he has deposited money after that. If you read this 30th June as 2021, then you will interpret that this money is also deposited in the capital gain account before the due date of filing return. So you need to be very careful. This is deposited after the due date of filing return, so this will not be taken into account for the purpose of computation of exemption. So what will be taken into account is cost of land 7.5 lakhs and 4.5 lakhs amount deposited in the capital gain account within the due date of filing return. So basically 12 lakhs will be taken into account for the purpose of computation of exemption under section 54. So let's move on to situation B. This amount is 12 lakhs 22,500. Purchase of land for 7 lakh 50 deposited in the account within the due date of filing return is 4 lakh 50. Total investment is 12 lakhs. This will be compared with 12 lakhs 22,500. Whichever is lower, 12 lakhs, that will be the amount of exemption. So from 12 lakhs 22,500, you deduct 12 lakhs. So balance capital gain is 22,500. Is that very clear? Important note for you. Cost of land is an integral part of cost of construction. Therefore, exemption can be availed even for the cost of land. Deposit in capital gain account after the due date of filing return is not eligible for exemption in section 54. Therefore, we have not claimed exemption for which amount? Yes, 1 lakh 80. For this 1 lakh 80,000, for this 1 lakh 80,000, we have not claimed any exemption. So this should not be taken into account. So situation B is also over from my side. Let us move on to third situation. Situation C. He invested 9 lakh. He invested 9 lakh on construction of an additional floor at a residential house property already owned by him. So here he is not acquiring new property. He is not acquiring new property. He is having, say, for example, 2 properties. Out of 2 properties, 1 property has sold. Long-term capital gain has arisen on transfer of that 1 property, and that money which he has realized, he has used for constructing additional floor on the second property which is owned by him. Can he claim exemption? Neither he has purchased the property nor he has constructed the new property. Answer is he can still claim exemption because money realized on the sale of old property is utilized for construction activity only. So even if it is an existing property, there is an expansion, additional floor is added to that existing property, you can claim the exemption under section 54. Okay, let's move on to third situation. It says 9 lakh is invested in construction of additional floor at a residential house property already owned by him. This investment is made during the period 1st October 20 to 31st December 20. 1st October 20 to 31st December 20 is in your previous year itself. So can you claim the exemption for 9 lakhs? Yes. The purpose of situation C is to make you understand that even if you don't buy new property, even if you don't construct the new property, you are doing the construction on the existing property also, then also you are eligible to claim the exemption. That is the purpose of this example. Situation C, your gross capital gain is 12 lakhs 22,500. Construction of additional floor at a cost of 9 lakhs. This will be compared with 12 lakhs 22,500. Amount eligible for exemption is 9 lakhs. So what is taxable amount? 3 lakhs 22,500. Is that very clear? Okay. Note says construction of additional floor of the existing house is considered as a construction of new house only. Therefore, it is eligible for exemption. It is eligible for exemption. So, situation C is over. Now, let's move on to the last situation. It says he has invested 10 lakh in capital gain account scheme on 29th June 21. This 29th June 21 is before the due date of filing return. It is before 31st July 21. So, this 10 lakh deposited in the capital gain account will be eligible for claiming exemption. 1 lakh is deposited on 1st July 21. This will also be eligible because this is before 31st July 21. And 3 lakh is deposited on 1st August 21. This will not be eligible for claiming the exemption because this is deposited after the due date of filing return. So, this 3 lakh should be cancelled. So, what we should take into account is 10 lakh plus 1 lakh, that is 11 lakhs. Now, read the next sentence very carefully. He purchased a house on 5th April 2022 for 9 lakh by withdrawing money from the scheme. No further investments were made by him. See, first of all, please understand that the house is purchased. Now. He has not paid money from his own pocket. He is withdrawing money which he had deposited in the capital gain account. That money is utilized for purchasing the house. So that is what was expected from him. Whatever amount he had deposited in the capital gain account, based on that we had given him exemption. So he is expected to withdraw money from that account and utilize for purchase of new property. But the point is, he has utilized only 9 lakhs. Last sentence says, no further investments were made by him. Means, some unutilized amount will become taxable. When unutilized amount will become taxable? On the expiry of period of 3 years. On the expiry of period of 3 years. 3 years from which date? 3 years from the date of transfer. From the date of transfer, 3 years we should count. That date falls in whichever year, in that year, unutilized amount will become taxable. And you already know what is the format for calculation of unutilized amount. You have to write 4 points and you have to write amount against each and every point. So, first of all, forget about the unutilized amount. First of all, let us calculate the exemption. So, how much amount we would take into account for computation of exemption is 10 lakh plus 1 lakh, that is 11 lakhs. So, situation D, my gross long term capital gain is 12 lakhs 22,500. 10 lakh is deposited plus 1 lakh is deposited, total 11 lakh is deposited in the capital gain account within the due date of filing return. That will be compared with the gross capital gain of 12 lakh 22,500. So 11 lakh is eligible for exemption. Out of 12, 20 to 500, 11 lakh is eligible for exemption. So what is taxable is 120 to 500. 120 to 500 is taxable. Yes. Note says amount deposited in the capital gain account scheme after the due date of filing return is not eligible for exemption. This note is talking about which amount? Yes. Note is talking about which amount? 3 lakhs. Yes or no? This 3 lakhs will not be taken into account for the purpose of computation of exemption. Only for your reference, I am writing 3 lakh and cancelling it. Now you tell me, when the period of 3 years will expire? Our exemption calculation is over for situation D. Now we have to calculate what? Now we have to calculate taxability on expiry of 3 years period. Taxability of what? Taxability of unutilized amount. What is the date of transfer? 16th July 20. From that date, you count 3 years. It will be 15th July 21, 15th July 22 and 15th July 23. That 15th July 23 will fall in which year? 23, 24. 23, 24. So previous year it is 23, 24. Date of transfer original house was 16 July 20. Time limit for utilizing money deposited in the capital gain account is 15th July 23. Correct? So let us now move on to understand how to calculate the taxable amount, taxable portion of unutilized amount. First of all, tell me how much amount was deposited in the capital gain account. How much amount you have deposited in the capital gain account? Quickly, yes. Deva madam, 11 lakh is not deposited. Something more is deposited. How much is deposited in capital gain account is 14 lakhs, not 11 lakhs. Yes or no? 14 lakh is deposited in the capital gain account. Out of 14 lakhs, how much amount was taken into account for the purpose of computation of exemption? That was 11 lakhs. That was 11 lakhs. Now you tell me how much amount is utilized. Only 9 lakh is utilized. Only 9 lakh is utilized up to 15 July 23. Up to 15 July 23, 9 lakh is utilized. So what is unutilized amount? Taxable 2 lakhs. 2 lakhs. See, if you see, you have deposited 14 lakhs in the bank account and you have utilized, you have deposited 14 lakhs in the bank account. Out of that, you have utilized 9 lakhs. So what is lying in your bank account is 5 lakhs. What is lying in the bank account is 5 lakhs. But we are not levying tax on 5 lakhs. We are levying tax only on 2 lakhs. What is this difference of 3 lakh? The amount which was deposited in the account after the due date of filing return, and that was not taken into account for the purpose of computation of exemption. Because of that, there is a gap of 3 lakhs. So let us now read the note. If the amount withdrawn from the capital gain account is not utilized for the specified purpose. What is specified purpose? Either purchase of new property or construction of new property. Then amount not so utilized shall be taxable as long-term capital gain in the year in which period of 3 years from the date of transfer of original asset expires. So on the expiry of 3 years, you have to make this format and find the taxable amount. Yes, have you all understood this? Yes or no? So we have completed the discussion of section 54 in detail along with a practical question on it, and that was question number 15. Now we'll move on to next section, and next section is section 54B. My target is to complete this section within 15-16 minutes. So right now it is 8:14 in my watch. My target is to complete this by maximum 8:30. By maximum 8:30 I will complete this section. Now listen to me carefully. Before I actually move on to section 54B, Let me give you some idea what is section 54B, only basic idea, and then we'll go through the provision. See, section 54, section 5454 is giving you exemption. The asset which is sold, the capital asset which is sold is residential house property, and the capital asset which is acquired is also a residential house property. In that case, you can claim exemption in section 54. Similar to section 54, we have section 54B. In section 54B, the capital asset which is sold is a agricultural land. Definitely which agricultural land? Urban agricultural land. Why? Because rural agricultural land is not a capital asset only. So there is no question of computation of capital gain only. If there is no question of computation of capital gain, where does the question arise for exemption? So, which agricultural land you have transferred is a urban agricultural land. There is a capital gain which has arisen on that urban agricultural land. Government says that capital gain we will not levy tax, we will exempt you. We will exempt you provided you acquire new agricultural land. New agricultural land can be acquired in urban area or it can be acquired in rural area. It can be acquired anywhere. So, the agricultural land which is sold is definitely a urban agricultural land, but agricultural land is which is acquired is a either urban agricultural land or rural agricultural land. Whatever capital gain has arisen on transfer of old agricultural land, that capital gain will be exempted if you acquire new agricultural land either in urban area or in rural area. Definitely, as usual, we have the time period to acquire the new agricultural land. If you could not acquire new agricultural land within the due date of filing return, we have the facility of opening a capital gain deposit account, depositing money in that account and then claiming the exemption. Thereafter, utilizing that money to acquire the new agricultural land. And if you could not utilize within the time limit prescribed, then on the expiry of that time limit, unutilized amount will become taxable. And similarly, one more point, there is a lock-in period for the new agricultural land which is 3 years. If you transfer the new agricultural land within 3 years, then what will happen? We will calculate capital gain on transfer of new agricultural land. While calculating such a capital gain from the cost of acquisition of new agricultural land, we would deduct the amount of capital gain exempted earlier. So the cost will reduce and capital gain will increase. So most part of this section is similar to section 54. Till now, I have given you only one point which is a distinction point as compared to section 54. That is, in section 54, the asset which capital asset which was sold was a residential house property and the capital asset which was acquired was also a residential house property. Whereas in section 54B, the capital asset which is transferred is a urban agricultural land and capital asset which is acquired is also an agricultural land. It can be either urban or it can be rural. This is a one point distinction between section 54 and 54B. Definitely we have certain more points which are different in section 54B as compared to section 54. That we will discuss when we, the moment we move ahead with the reading of the provision. So I have just given you an idea saying that section 54B is similar to section 54 in all aspects. The difference is here agricultural land is sold and agricultural land is acquired. So let us try to read the provision and understand it. While reading the provision in section 54B, you should always try to compare section 54B with section 54 and try to find out what is different in section 54B as compared to section 54. Always we'll try to compare the two sections. Section 54B Who can claim exemption? Only individual and HUF can claim exemption. In section 54 also, only individual and HUF was claiming exemption. Here, the capital gain which has arisen on the transfer of old land can be either long-term gain or short-term gain. This is the distinction point. This is the distinction point. In section 54, exemption was available only if long-term capital gain had arisen on transfer of residential property. Here, exemption is available even if the gain is short-term. So, this is the distinction point. This is point number 1 distinction in section 54B as compared to section 54. Further, let's move to next point. Which capital asset is eligible for exemption? Section 54 says residential house property is transferred. Here what is transferred? Agricultural land is transferred. Which agricultural land? Urban agricultural land, that is implied because rural agricultural land is not a capital asset. Further it says agricultural land should be used by the individual or his parents for agricultural purpose during 2 years immediately prior to the date of transfer. There was no such condition in section 54 saying that residential property should be used for residential purpose 2 years prior to the date of transfer. There is no need to put that condition because residential property will be definitely used for residential purpose only. It cannot be used for any other purpose. But agricultural land, it is not necessary that on that agricultural land you are doing agriculture. That may lie as it is without doing agriculture activities. That land is lying as it is. In that case, if you sell, capital gain will not be exempt. Capital gain will be exempt only if that agricultural land was used for agricultural purpose, meaning thereby you were doing the agricultural activities on that agricultural land. In the last 2 years, if you are not doing agricultural activities on that agricultural land, and if you sell the agricultural land, in that case you are not eligible to claim any exemption. Now, natural question will arise. Dikshit, we are covering every point, don't worry. Don't worry, we are covering every point. I have seen your message. I will cover every point. All these points will be covered. Slowly, let me go through each and every point. We will try to identify the distinction. Every point will be analyzed. Once I complete section 54B, thereafter if you still have doubt, please do ask. So right now, I am focusing on asset which is transferred. I am focusing on asset which is transferred. The asset which is transferred is a agricultural land. Agricultural land. So there is a capital gain which has arisen. There is a capital gain which has arisen on transfer of this agricultural land. This capital gain will be exempt provided that agricultural land was used either by the SSE or his parents or his HUF for at least 2 years prior to the date of transfer. If agricultural land was not used for agriculture purpose for at least 2 years prior to the date of transfer, then any capital gain arising on such agricultural land will not be eligible for exemption. Dikshit, I will cover your point after some time. Give me 2-3 minutes. I will cover that. In the next point itself, we are going to cover it. First of all, have you understood this 2 years condition? Such 2-year condition was not there in section 54. Now let's move on further. Which asset taxpayer should acquire to claim the benefit of exemption? He should acquire agricultural land. Where he should acquire? He can acquire in urban area or rural area. He can acquire anywhere. He can acquire anywhere. Now, can you tell me what is different in section 54B? First of all, here we are acquiring agricultural land. And number 2, where this new agricultural land is required to be acquired is not clearly mentioned. So, can you acquire outside India? Provision is silent as of now. So yes, you can acquire outside India. But in that case, if income tax officer objects, then you have to fight a case with the department and definitely you will win the case. So agricultural land which you are acquiring, this can be in India also or it can be outside India also. Same thing is also there for agricultural land which is transferred. Agricultural land which is transferred, that can also be outside India or in India, because provision doesn't mention which agricultural land you have transferred. So agricultural land which you have transferred here, that can be in India or outside India. Agricultural land which you are acquiring here, that can also be in India, outside India. Now you may think that how the agricultural land outside India, if it is transferred, there would be capital gain in India. You know that if SSC is ordinarily resident, in that case his global income is taxable in India. His global income is taxable in India. In that case, if India is having double tax avoidance agreement with that another country, in that case treatment will be given as per double tax avoidance agreement. And if as per that double tax avoidance agreement, if capital gain is being taxed in India, then definitely exemption will be available. But if as per that double tax avoidance agreement, capital gain is taxed outside India, then there is no question of exemption because there is no gain in India. Yes? But very important point to be noted is the new agricultural land which we are acquiring, that can also be acquired outside India. Now what is the time limit for acquiring new agricultural land? It is 2 years forward, means 2 years from the date of transfer. Why 3-year period is not given? Because agricultural land cannot be constructed, only it can be acquired. Construction is not possible. Plus government has not given 1 year backward period. Government is just giving you 2-year forward period, that's all. Backward period is not given, plus 3-year period is not covered here. This 2-year forward period should be taken from which date? From the date of transfer. From the date of transfer. What will be the amount of capital gain exemption? That is same as section 54. I am not re-explaining you once again. The exemption will be lower of following two amount. Number 1, gross long-term capital gain. Number 2, amount actually invested in purchasing agricultural land up to the due date of filing return, plus amount deposited in the capital gain account up to the due date of filing return. Amount 1, amount 2, whichever is lower. Now still very important point is, can you acquire 2 agricultural land by selling 1 agricultural land? For example, you have sold 1 agricultural land in India and you acquired 2 different plots of agricultural land in 2 different locations in India. In residential house property, there was a restriction saying that if you sell 1 property, you have to acquire only 1 property. If you acquire 2 property, we are not going to give you exemption for 2 properties. Yes, you can claim exemption for 2 property if the amount of capital gain does not exceed 2 crores and such relief is available only once in a lifetime. That provisions, those provisions we discussed in 54, they are not covered in section 54B. In other words, if you have sold 1 land, you can acquire 2 plot of land, 3 plot of land, 4 plot of land, whatever number of plot of land you want to acquire. So 1 land sold, multiple land can be acquired. Multiple land is so, multiple land sold, 1 land can be acquired. So that is allowed. On the new agricultural land which is acquired, there is a lock-in period of 3 years. You cannot transfer within 3 years. If you have transferred within 3 years, then what will happen? We will calculate capital gain on transfer of new agricultural land, and while calculating such capital gain, from the amount of cost acquisition, we will deduct the amount of we will deduct the amount of capital gain exempted earlier, as a result of which your cost acquisition will reduce, your capital gain will increase. That increased amount of capital gain would consist of 2 things: gain on transfer of new agricultural land, and number 2, amount which was exempted earlier, that amount is taxed right now. That will also form part of that taxable amount. So we have covered section 54B. See, sharp it is 8:29 right now in my watch. Exactly I have covered this section in 15 minutes. Now we move on to a practical question. And that is question number 16. Question number 16. We'll move on to question number 16. See, once you have understood section 54 in detail now, then all other sections, more than 50-60% content is same. Intentionally, I took a lot of time in section 54. See, yesterday we had started section 54. We discussed in so much detail, taking numerical example, different situations, taxability of unutilized amount, taxability of property sold. Everything we discussed with the help of numbers, taking different situations. Once that is done, we also revised section 54 entirely today also. Only with the intention to ensure that your understanding with respect to section 54 is very much clear, so that further part of the chapter becomes easy for you. So we completed this section 54B in a span of 15 minutes, but we had devoted around 1.5 hour time to section 54. It was intentionally done in that manner only. Anyway, let's move on to question number 16. R had purchased a certain agricultural land in 2003-4. Do you believe that agricultural land is a capital asset? Yes, if it is situated in urban area. No, if it is situated in rural area. This was acquired for 6 lakhs and year of acquisition is on or after 1st April 2001. So FMV on 1st April 2001 option is not available, and even if you are having FMV on 1st April 2001, you should totally ignore it. This land was being used for agriculture purpose by him. So that condition that SSE should use agricultural land for agriculture purpose 2 years immediately prior to the date of transfer, that condition is fulfilled. Referring to this sentence, you can say that that condition is fulfilled. This land is sold by him on 2nd September 20 for 26,50,000. So this 2nd September 20 falls in your previous year 2021, and this 26,50,000 would be your full value of consideration. Further it says he has spent 1 lakh for acquiring urban agricultural land on 21st October 20. 21st October 20 is within your previous year itself. So this amount of 1 lakh will be eligible for exemption, and has deposited 2,50,000 under capital gain account scheme on 15th April 21. This is deposited prior to the due date of filing return, that is 31st July 21. So this amount will be eligible for computation of exemption. Out of the amount deposited, please understand, he is not spending money from his own pocket. Whatever he had deposited in his capital gain account, he is withdrawing that amount. How much amount was deposited in capital gain account? 2,50,000. Out of that 2,50,000, he has withdrew 1 lakh rupees. See, intentionally examiner is trying to confuse you by once again giving you the amount of 1 lakh. The old agricultural land which was acquired, that was also acquired for 1 lakh. 2,50,000 was deposited in the capital gain account. Out of that 2,50,000, some amount is withdrawn and new agricultural land is acquired. But that is also acquired for 1 lakh. So 2 agricultural lands are acquired. Both are acquired for 1 lakh each. So out of the amount deposited, he withdrew 1 lakh for purchasing agricultural land on 15th March 22. 15th March 22, he has acquired new agricultural land. This new agricultural land should be acquired within a period of 2 years from the date of transfer. Date of transfer is 2nd September 20. From that 2 years would be 1st September 22. Has he acquired before that? Yes, he has acquired in the month of March 22 itself. So this will be, in fact, this 1 lakh should not be taken to account for computing exemption. 1 lakh is part of 2,50,000. 2,50,000 will be taken to account for computing exemption. This 1 lakh is just amount utilized within the span of 2 years. The remaining amount could not be utilized for purchase of agricultural land up to 14th April 23. Can you tell me what is this 14th April 23? See, examiner is trying to create a lot of confusion. Can you tell me on which date? I want to explain you two important point with respect to this question number 16. Please don't proceed further. Question number 16. I am asking you few questions. Please answer me those questions. What is the date of transfer? What is the date of transfer? Yes? 2nd September 2020. From this date of transfer is 2nd September 2020. Now from this date, you know that new agricultural land is required to be acquired within a span of 2 years. So what is the time limit to acquire new land? Is nothing but 1st September 22. Yes or no? Now, if you have not acquired new agricultural land by 1st September, by mistake I have written 20 here. If you have not acquired the new agricultural land by 1st September 22, then what will happen? Whatever amount is lying unutilized in the capital gain account should become taxable on the expiry of that period. So, this date falls in which year? 22-23. This date falls in 22-23. Now you tell me, what is the date of depositing money in capital gain deposit account? What is the date of depositing money in capital gain deposit account? On which date you had deposited 2,50,000? 15th April 21. Examiner knows that the time limit to acquire new property is 2 years from the date of transfer. But he intentionally wants to create a confusion. So intentionally he has calculated a time period of 2 years from the date of depositing money in the capital gain account. So from this date, if you exactly calculate 2 years, that would be 14th April 2023. This date he has given you in the question. If you look at this date and then you levy tax on unutilized amount, then the year will be different. Actually, unutilized amount should be taxed in which year? When the time limit of 2 years expires from the date of transfer. That is previous year 22-23. That is corresponding assessment year will be 23-24. But examiner wants you to do mistake. That is the reason. He has intentionally calculated this 2 years period from the date of depositing money in the capital gain account, and this date he has clearly given you in the question. So it may happen that you may levy tax on unutilized amount in the year 23-24. That is corresponding assessment year 24-25. If you do this, that would be totally incorrect. So unutilized amount will not be taxed in previous year 23-24. It will be taxed in previous year 22-23. That should be very much clear in your mind. Have you understood what I have tried to explain you? Yes? So intentionally such kind of things are done to confuse you. See, right now it may happen that you might have understood this point at a first glance itself while you were reading the question. In fact, there was no need for me to explain this point. Few of you might have realized it. But in the examination, the environment is different. You might have seen a lot of students coming out of the examination hall and saying that I have done a lot of silly mistakes. So that environment of the examination is such that you tend to do small mistakes. So remaining amount could not be utilized for purchase of agricultural land up to 14th April 23. 14th April 23 falls in 14th April 23 is not relevant for us because they have counted 2 years from the date of depositing money in the capital gain account. So this date should not be taken into account. This is given only to confuse you. Compute the taxable capital gain for the assessment at 21-22, 22-23, 23-24 and 24-25. Now the 4 assessment years they have given. So corresponding 4 previous years would be 2021, 21-22, 22-23 and 23-24. So for 4 different years, what would be the treatment in these 4 different years? That is what you have to explain. If the agricultural land which was sold is urban agricultural land, situation A, and situation B, rural agricultural land. The situation B answer is simple. Rural agricultural land is not a capital asset as per section 2 clause 14. Therefore, there is no question of computation of capital gain. And definitely there is no question of exemption also because there is no capital gain. The important part is situation A, that is the agricultural land which is transferred is a urban agricultural land. It is a urban agricultural land. So let us move on to calculate the capital gain, etc. Format is given to you in the book itself. Which page it is given? It is given on page number 230. 230. Now listen to me very carefully. While making the solution, they have asked you the treatment for 4 years. So what you have to do now? You have to look at the dates given in the question. You have to look at the dates given in the question. Refer to the dates given in the question. Based on that, decide what is going to happen on that particular date, and based on that, give the treatment in that particular year. First of all, if you start reading the question, the first date which is given in the question is 2nd September 20. 2nd September 20 falls in your previous year 2021, assessment year 21-22. In this previous year 2021, agricultural land is transferred. Period of holding is from 2003-4 to 1st September 20. This is more than 24 months. Therefore, asset is a long-term capital asset. So you have to calculate long-term gain. Tell me what is full value of consideration in your case? 26,50,000. Yes. What is the amount of expense on transfer? Not given the question. Means it is 0. Net consideration is 26 lakhs 50,000. From this I should deduct the cost of acquisition. Can you tell me what is my actual cost of acquisition? 6 lakhs. This is given in line 1. But what is the fair market value on 1st April 2001? This is not applicable because the agricultural land was acquired in 3-4. Even the fair market value is not given in the question. In fact, examiner should have given you so as to confuse you. But he has not given only. So 6 lakhs into index number for which year? 2021. That is 301. Divide by indexation for which year? 2003-4. What is the index number of 3-4? 109. Now give me the amount of index cost of acquisition. 1656,881. 1656,881. 16 lakhs 56,881. I don't have index cost of improvement. So get me the amount of long-term capital gain. See, I am not knowing what is the correct answer. Huh? So all of you, whatever answer you give now, that is correct. 993,119. 9,93,119. 993,119. Okay. So this is the amount of long-term capital gain. Now, this calculation we have done in which year? Previous year 2021, corresponding assessment year 21-22, correct? Now let us first of all calculate the exemption. Here till now we have just calculated the capital gain. Now we have to calculate the exemption. What is the date of transfer of original agricultural land? 2nd September 20. It is given in line number 2. So what is the time limit to acquire new agricultural land? 2 years from this date. That is 1st September 22. Can you tell me what is the actual date of purchase of new agricultural land? 21st October 20. Is that within the time limit of 2 years? Yes. So let us move on to calculate the long-term capital, calculate the exemption. 993,119 is the gross long-term capital gain. 993,119. Less exemption in section 54, clause B. Lower of following two amounts. Number 1, purchase of agricultural land on 21st October 20. 21st October 20, you acquired agricultural land for how much? 1 lakh rupees. How much amount is deposited in the capital gain account? 2,50,000. Yes or no? And this is deposited on 15th April 21. So total investment is 3,50,000. This 3,50,000 will be compared with the amount of capital gain, which is 993,119. So what will be exempted is whichever is lower. 3,50,000 will be exempted. Deduct the amount of exemption from your from your gross capital gain of 993,119. You get the balance as 643,119. 643,119. 643,119 is your taxable long-term capital gain. Is that very clear? Yes or no? Okay, now let's move further. Now you tell me what is the next date in the question. See, go line by line. In the first line, no date is given. Second line, they have given 2nd September 20. That is the date on which the agricultural land was sold. So that capital gain we have calculated. Next date is 21st October 20. On that date, you had acquired the new agricultural land. That is also taken into account. Next line is amount deposited in capital gain account on 15th April 21. That amount deposited in the capital gain account is also taken into account. Next date is 15 March 22. See, 15 April 21 and 15 March 22, both dates are falling in the same financial year. Na? 15 April 21 and 15 March 22, both dates are falling in the same financial year. 15 April 21, what is happening? Amount is deposited in the capital gain account. 15 March 22, what is happening? Yes? What is happening on 15 March 22? He has withdrawn money from the capital gain account and he has utilized for purchasing new agricultural land. So that is okay. let him withdraw. That is what he is expected to do. So, in the previous year 21-22, corresponding assessment at 22-23, two dates are falling in this year 21-22. The first date is amount of depositing money in the capital gain account, and the second date is 15 March 22. On this date, he is withdrawing money from this account. What is the tax treatment on this? There is no tax treatment. Exemption is already given to him. Exemption is already given to him. That exemption was conditional exemption, saying that if you have deposited money in the capital gain account, you claim the exemption right now, and later on you withdraw the money and utilize for acquiring the new asset. So that is what he is doing. So he is not going to get something extra. Whatever benefit we wanted to give him in the form of exemption is already given to him in the previous year 2021. So previous year 21-22, we say that during the previous year 21-22, SSC is purchasing land by withdrawing money from the capital gain account, for which he has already claimed exemption in section 54B. Hence, there are no tax consequences in the previous year 21-22, and that is the corresponding assessment year 22-23. Is that very, very clear? Yes or no? Examiner has asked you tax treatment in 4 years. So out of 4 years, we have covered up first year 2021 and 21-22. Yes. Now the third year is what? 22-23. In third year, what is going to happen? The time limit for acquiring the new agricultural land will expire. On which date it will expire? That date is not given to you in the question intentionally. Intentionally, that date is not given to you in the question. So you have to calculate that date. So previous year 22-23, assessment year 23-24. Original agricultural land was transferred on 2nd September 20. Time limit for acquiring new agricultural land is 2 years from this 2nd September 20. That is 1st September 22. This 1st September 22 is nowhere given to in the question. This date you have ascertained. This date you have ascertained. This is not given in the question. See how intelligently examiner has played with your psychology. Tell me what is the amount deposited in the capital gain account? 2,50,000. How much exemption we had given you? For calculating exemption, entire 2,50,000 was taken into account. Na? We gave you exemption for 3,50,000. So out of 3,50,000, we gave you exemption for 250 for depositing money in the capital gain account. So in this case, my amount deposited in the capital gain account and the amount which was taken into account for the purpose of computation of exemption, both are same. $2,50,000, $2,50,000. See, when your second amount will be lower than the first amount, when your second amount will be lower than the first amount, when your investment is more than the amount of capital gain. When the investment is more than the amount of capital gain, in that case, your second amount can be more than the, first amount can be more, second amount can be. When your second amount generally will be less than the first amount, or it will be equal to the first amount. Second amount can never be more than the first amount, because first amount is amount deposited in the capital gain account and second amount is out of that deposited amount, how much was taken into account for the purpose of computation of exemption. So for example, you deposit 5 lakhs. In that case, we can give you exemption for maximum 5 lakhs. Exemption cannot be more than 5 lakhs. Exemption can be either 5 lakhs or it can be less than 5 lakhs. It can also be less than 5 lakhs. In that example which I had given you for explaining section 54, there you had deposited 60 lakhs in the capital gain account. But we had not given you exemption for 60 lakhs. We had given you exemption for 48 lakh 93,000. So your exemption can be less than the amount deposited, it can be equal to the amount deposited, but it cannot be more than the amount deposited. So your amount deposited is 2,50,000 and your exemption was also 2,50,000. Now tell me, out of this 2,50,000, how much amount you have utilized up to this 1st September 22? 1 lakh, only 1 lakh. So how much unutilized amount will become taxable? 1,50,000 will become taxable. 1,50,000 will become taxable. Have you understood this very clearly? Read the note, what it says. If the amount withdrawn from capital gain account scheme is not utilized for the specified purpose, then amount not so utilized shall be taxable as long-term capital gain in the year in which period of 2 years from the date of transfer of original asset expires. Here it is 2 years. In section 54, it was 3 years. So previous year 22-23 assessment year 23-24, third year is over. Next year is previous year 23-24 assessment year 24-25. Which is the date given to in the question which is pertaining to this previous year 23-24 is 14th April 23. What is that 14th April 23? I already explained you that 14th April 23 they have intentionally calculated 2 years period from the date of depositing money in the capital gain account. This date is not relevant at all. Intentionally, with the intention to create a confusion, this date is given to in the question. So we should tell to the examiner, don't try to fool us. This date is not relevant. So it says the time limit for purchase of agricultural land by withdrawing money from the capital gain account is 2 years from the date of transfer of original agricultural land and not from the date of deposit of money in the capital gain account. These words are important. 2 years should not be counted from the date of depositing money in the capital gain account. So therefore, there are no tax consequences during the previous year 23-24, that is the corresponding assessment at 24-25. Is that very, very clear? Yes. So with this situation, A is over. Case A is over. Case B already we discussed. Case B is what? Agricultural land is rural agricultural land. In that case, we say that it is not considered as capital asset as per the definition of capital asset which is given in section 2 clause 14. Therefore, there is no capital gain on transfer of rural agricultural land. There is no tax consequence. So case B is also over. With this, we have covered up question number 16. See, I don't know whether you have observed or not. I have taken practical question for most of the situations. Most of the situations now, I have taken practical question. Also 3-4 questions are given to you as homework. If you see on page number 215, practical problems, do it yourself. Question number 20, 21, 22 and 23. 4 questions are given to you. Solution is also provided. But out of 4, 1 I will do it in the class. Out of 4, 1 I will do it in the class, and that is question number 23. Question number 23 we will discuss in the class. Till now we have completed 2 sections, 54 and 54B. And on that we have done question number 15 and 16. Now we need to move on to next section. Now we are moving on to the next section, that is section 54D. This will take around 15 to 20 minutes time. Slightly different as compared to earlier 2 sections, and 2-3 extra points here and there, that's all. Otherwise, it is similar to what we have learned in section 54 and 54B. Now, before I actually move on to section 54D, I will summarize section 54D as to how different is this section as compared to earlier 2 sections, and then we will refer to each and every point of the section. See here, Here there is a industrial land and building. There is a land and building situated in an industrial area, and government of India wants to execute some project there. So that land and building is coming in between. So for executing the project in that industrial area, government has compulsorily acquired some land and building from different persons. Already you know that as per section 45 subsection 5, compulsory acquisition is considered as capital asset and capital gain will be applicable. So in this case there is a land and building. This land and building is forming part of an industrial undertaking. This land and building is compulsorily acquired by the government. So definitely yes, this is considered as transfer, there would be capital gain. Therefore, there arises the question of exemption of capital gain. Now very important point to be noted here is, while doing the compulsory acquisition, government will not see whether the person is individual or HUF or person is a company or firm. They'll simply do the compulsory acquisition. Therefore, in this section, exemption is granted to all persons, whosoever it is, whether it is individual, HUF, firm, company, whosoever's land and building is compulsorily acquired, there would be a capital gain and he can claim exemption. But this is not a normal land and building. This is a land and building which is forming part of an industrial undertaking. So it is used for industrial purpose. It might be a factory premises, etc. So in section 54B, the land was agricultural land. Here, this land and building is an industrial land and building. So factory might be there, and that factory premises along with the plot of land is compulsory required by the government. Now government says, first of all you calculate capital gain, then you claim the exemption. We will give you exemption on whatever capital gain has arisen on transfer of that land and building as part of compulsory acquisition. So you calculate the capital gain and then you are eligible to claim exemption in section 54D. 54D says, for claiming exemption, you have to acquire new land and building. And that new land and building should also be acquired in an industrial undertaking. See, land has to be acquired. Building can be either acquired or it can be constructed. So government has given some time period for acquisition construction. You acquire that new land and building in an industrial area only, and we will give you exemption for that old land and building which is taken up by the government as part of compulsory acquisition. All other conditions are similar to what we have discussed in 54 and 54B. I want to just tell you two important points. And that important point is, here the land and building is compulsorily acquired. This land and building is forming part of industrial undertaking. In other words, this land and building might be a factory premises. You know that land is a non-depreciable asset. So land will not be generally forming part of any block of asset. So you might not have claimed any depreciation on that land. That land, if it is sold, if it is compulsorily acquired, you calculate capital gain independently, only on that plot of land. But you also know that building is a depreciable asset. In case of business organization, building would form part of block of asset. You might have claimed depreciation on that block of asset. So, if one of the building from the entire block is compulsorily acquired, then whatever compensation you receive, you have to calculate capital gain based on the block approach. So basically, whatever we had discussed in the chapter of PGBP, in that example number 1, case 1, case 2, case 3, case 4, that approach will be followed. In other words, capital gain will be calculated not by applying the provisions of section 45 subsection 5. Definitely there is compulsory acquisition, so 45(5) is applicable. But capital gain will be calculated based on block method. So you will have opening WDV of block of asset. To that, whatever asset you have acquired, you add the value of actual cost to that block. From that you deduct the selling price. Here it is no selling price. Here it is nothing but the compensation received from the government. You deduct the amount of compensation from the value of block. The balance is WDV. If you have a positive WDV and there are assets in the block, then there won't be any gain, there won't be any loss. There will be depreciation. In that case, since there is no gain, there is no question of exemption. So question of exemption would arise only if there is a gain. And you know that that gain will be as per section 5050, and that gain is considered as short-term capital gain only. That is considered as short-term capital gain. If you want me, then I can give you the page number of the PGBP chapter where we had discussed this example. Do you recollect that example of block of asset, profit or loss on sale of asset? Yes or no? Page number 110, page number 110. So I'll take you to that PGBP point. See this example number 1. So in case of an industrial undertaking, that building would be forming part of block of asset. That building is compulsorily acquired by the government. So government is going to give you compensation. The year in which compensation is received, that amount of compensation should be deducted here. As if that asset is sold to the government, you deduct the amount of compensation here. Thereafter, if the value of the block is positive, there are assets in the block, then you will calculate depreciation. In that case, there is no capital gain. Since there is no capital gain, there is no question of exemption. So question of capital gain would arise in which situations? Out of these 4 cases, capital gain would arise in which case? It would arise only in the second and the fourth case. Second and fourth case you are having capital gain. First case you don't have capital gain, you don't have capital loss also. Second case you are having capital gain. This capital gain will be short-term capital gain. This is as per section 5050. And here also you have short-term capital gain in case number 4. So, if your closing WDV for charging depreciation turns out to be negative after deducting the amount of compensation from the value of block, only in that case you will have the capital gain. And only in that case there is question of claiming exemption. Is that very, very clear? Yes? Have you understood this? Now let me cover up one more point right now. I did not intentionally cover this point in the chapter of PGBP. Let me cover that point right now relating to section 5050. In the chapter of PGBP, I told you that in second case there is capital gain, short-term capital gain. In fourth case there is short-term capital gain. In third case there is short-term capital loss. There is short-term capital loss. Question is why this is short-term or long-term? Because government says this asset should not be, asset which is sold out of the block should not be identified separately. Now for example, there are 500 assets in the block. Out of 500 assets, you have sold 20 assets. If you try to find out what is the actual period of holding for all those 20 assets, you may get period of holding more than 2 years also, less than 2 years also, more than 3 years also. So how do you decide whether the asset is long term or short term? Will you ascertain the weighted average period of holding? No, you can't do this. Therefore, government in section 50 has clearly mentioned that whenever there is a gain or loss in case of sale of asset from the block, in that case your gain will be short term gain or short term loss, you won't get any indexation. So section 50 provision is clearly specifying that your gain will be short term, your loss will be short term, you won't get the benefit of indexation even if it is long term. Even if the period of holding in this case is more than 36 months, you are not going to get any benefit of indexation. So here we have tried to understand that in case of block asset, capital gain may arise, capital gain may not arise. Only if capital gain arises, there arises the question of claiming the exemption. So keeping in mind these provisions, let's now move on to section 54D. Once again, in section 54D, you have to acquire new land and building forming part of an industrial undertaking. But if you are unable to acquire within the due date of filing return, then you have to open a capital gain deposit account, deposit money in that account. Based on that, we will give you exemption. Thereafter, you withdraw that money and within the prescribed time limit, you acquire new land and building in the industrial area. If you are unable to utilize within a period of 3 years from the date of transfer, then on the expiry of period of 3 years, we will levy tax on the unutilized amount. Same expression, similar to section 54. And the last part is whatever land and building you have newly acquired in industrial area, for that also there is a lock-in period of 3 years. Means you cannot transfer that land and building for a period of 3 years. What if you transfer? Then gain will be calculated on transfer of new asset plus whatever exemption was given to you, that exemption will also be withdrawn. So most of the provisions are same. So let us now try to understand section 54D. Who can claim exemption? Any person can claim exemption. I told you that while compulsorily acquiring the land and building, government will not see whether the other person is individual HUF or company or firm. They will simply compulsorily acquire the asset. So here government says everyone is eligible for exemption in section 54D. The nature of asset, it can be short term also, it can be long term also. Because while doing the compulsory acquisition, government will not see whether the asset is long term, short term. They will simply compulsorily acquire. So here government has inserted point saying that irrespective of whether the gain is short term or long term, you are eligible to claim exemption. But I have already told you that building is a depreciable asset forming part of block asset. So as per section 50, you will always have short term gain. But land is a non-depreciable asset. On that land, if the cost is given separately, you have to calculate capital gain independently. And if the period of holding of that land is more than 24 months, definitely there can be long-term capital gain. Which asset is eligible for exemption? Means which asset SSE has transferred. Which asset is compulsorily acquired? Land and building forming part of an industrial undertaking. Land and building forming part of an industrial undertaking which is compulsorily acquired by the government, and this land and building was used for industrial purpose for at least 2 years immediately prior to the date of transfer. Similar condition you had also seen in section 54B, but similar condition was not existing, not there in section 54. So section 54B says that agricultural land should be used for agricultural purpose at least 2 years prior to the date of transfer. Similarly, here also they have said that land and building forming part of an industrial undertaking which is compulsorily required by the government should have been used for industrial purpose at least for a period of 2 years immediately prior to the date of transfer. Then only you are eligible to claim exemption in section 54D. So this condition is similar to what we have seen in section 54B. What SSE has to acquire? SSU has to acquire land and building for industrial purpose, then he can claim exemption. What is the time limit for acquiring new land and building for industrial purpose? 3 years. 3 years. From which date? From which date this new land and building should be acquired? Within 3 years from which date? 3 years from the date of receipt of compensation. 3 years from the date of receipt of compensation. See, section 54, section 54B. We had written from the date of transfer and then we had written note 1. That note 1 I have not explained you. But here in section 54D, they say that period of 3 years should be seen from the date of receipt of compensation. From the date of receipt of compensation. I'll give you an example to make you understand this. Say for example, it is previous year 2021. You are having a residential house property. This residential house property is compulsorily acquired by the government on 15th August 2020. And government promised you a compensation of 50 lakhs. But this compensation was actually received on say 26 January 23, not 23, 24. Now tell me, what is the time limit for acquiring the new asset? Time limit for acquiring the new asset is generally, for purchase it is 2 years from the date of transfer, and for construction it is 3 years from the date of transfer. If you count 3 years from the date of transfer, that would be 14th August 2023. 14th August 23. But up to 14th August 23, you have not received the compensation. You received the compensation only in January 2024. In other words, till the expiry of period of 3 years, you did not receive the compensation. You don't have money. How you will buy the new asset? Therefore, to cover this situation, to tackle such a situation, wherein the asset is compulsorily acquired by the government and you are getting the compensation after a period of 3 years, whereas government is expecting you to invest money in a span of 3 years from the date of transfer. In this case, practically it is impossible for you to get the exemption. Therefore, government came out with section 54H. Government came out with section 54H. Your government is saying that the time limit for acquiring the new asset is generally 3 years for construction, 2 years for purchase. But the time limit should be recognized, should be ascertained from the date of transfer in normal circumstances. But in case of compulsory acquisition, the time limit should not be ascertained from the date of transfer, that should be ascertained from the date of receipt of compensation. And you also know that capital gain will also become taxable as per section 45 subsection 5 only in the year in which compensation is received. So your capital asset is definitely transferred by way of compulsory acquisition in the year 2021. But capital gain will not be taxed in 2021. Capital gain will be taxed in the year 23-24. Capital gain will be taxed in the year 23-24. So, capital gain will be taxed in the year 23-24, and that time limit for acquiring the new asset should also be recognized from 23-24 only. In other words, it should not be recognized from the date of transfer, it should be recognized from the date of receipt of compensation in case of compulsory acquisition. Yes? Now, Dikshit is asking me, sir, this time limit should be recognized from the date of receipt of compensation. That I agree. But this time limit should be counted from which date? Date of receipt of initial compensation or date of receipt of enhanced compensation? from which date this time limit should be ascertained. So answer is, you have to ascertain different dates. You have to also take 3 years from the date of receipt of initial compensation, and you also have to take 3 years from the date of receipt of enhanced compensation. You have to take from date of, partially you have to take whatever amount of initial compensation is received, you calculate capital gain, whatever is capital gain, for that amount you recognize the period of 3 years from the date of receipt of initial compensation. Thereafter, whenever enhanced compensation is received, you filed a case against the government and enhanced compensation was given to you, then you calculate capital gain once again in the year of receipt of enhanced compensation. There you claim the exemption, you make the investment within a period of 3 years from the date of receipt of enhanced compensation. So respectively you have to take for initial compensation from the date of receipt of initial compensation, for enhanced compensation from the date of receipt of enhanced compensation. So once again we are moving back to section 54D. So I have told you that 54 and 54B, while we discussed the section 54 and 54B, I told you that the period should be recognized, time limit should be recognized from the date of transfer. But now I am telling you that in case of section 54 as well as section 54B, if there was a compulsory acquisition, then the time limit for acquiring the new asset should be not from the date of transfer, but it should be from the date of receipt of compensation. So similar to section 54D it will happen. So in case of section 54D is covering only one situation, that is compulsory acquisition. 54D doesn't have anything called as sale. 54D is covering only compulsory acquisition only. So here it is never from the date of transfer, here it is always from the date of receipt of compensation. Yes, is that very clear? Yes, it is implied. Whatever example I take, it is implied that is land and building is forming part of an industrial undertaking. It will be clearly mentioned in the question that land and building is forming part of industrial undertaking. Next, what is the amount of exemption? The manner of computation of exemption remains the same. Same to same, no change. Exemption under section 54D will be lower of following two amounts. Number one, gross capital gain. Number two, amount invested in the new property within the due date of filing return plus amount deposited in the capital gain account within the due date of filing return. Take lower of 1 and 2, that will be the amount of exemption. Is there any lock-in period on the new asset? Yes, 3 years lock-in period. New asset which is acquired should not be transferred within a period of 3 years from the date of acquisition. If the new asset is transferred within a period of 3 years, what will happen? Capital gain will arise on transfer of new asset, and whatever exemption was granted to you earlier, that exemption will also be withdrawn. So there is no change in this case. So with this we have completed section 54D, and we have one question on section 54D, that is question number 17. So we move on to question number 17. What I will do now, I will read question number 17 and I will give you 1 minute's time to solve this question number 17 on your own. Format is already given for the solution. Format is given on page number 231. But I will read the question, I will make you understand, and then you try to solve within a span of 1.5 minutes, that's all. X Limited is a manufacturing company. Purchases a factory building on 6th May 2013. So they are talking about some past date. On this date, factory building was purchased for 20 lakh rupees. Prior to this, the company used the same building as a tenant for about 5 years. What is the importance of this sentence in the question? They are saying that prior to this, company used the same building as a tenant for about 5 years. referring to this section, referring to this sentence, you can say that condition of 2 years, using that land and building for 2 years for industrial purpose immediately prior to the date of transfer, that condition is fulfilled. So section 54D exemption can be claimed. See, whether that land and building forming part of industrial undertaking is used for agriculture purpose for 2 years, whether it is used by you or whether it is used by any other person, it will not make any difference. But in section 54B, they had clearly told you that agricultural land should be used for agricultural purpose by the SSE or his parents or HUF. Here, if someone else had used that here in section 54D, if you might not have used the land and building for industrial purpose, someone else might have used, that is also okay. But the point is, it should have been used for industrial purpose at least 2 years prior to the date of transfer. So referring to this sentence written in the bracket, you can easily say that yes, this land and building forming part of an industrial undertaking were used for industrial purpose for at least 2 years immediately prior to the date of transfer. This building is compulsorily acquired by the government on 20th April 20 for a sum of rupees 60 lakhs. 60 lakhs is the amount of compensation, and this amount of compensation is paid on 15th March 21. See, this X Limited is lucky enough. Government has compulsorily acquired their land and building on 20th March 20, and in the same year up to the end of the year they have also received the compensation. So here, year of compulsory acquisition and the year of receipt of compensation is same. Compute the amount of capital gain chargeable to tax for the assessment at 21-22, taking into account following information. Point number 1. On 1st April 20, company owns 2 buildings. Company is owning 2 buildings. Rate of depreciation is 10%. Out of 2 buildings, 1 is acquired by the government during 2021. Depreciated value of building on 1st April 20 is 21,35,000. See, they have clearly given you the information with respect to the block of asset. At the beginning of the year, opening value of the block was 21,35,000. So you take the opening value of block, to that you purchase the value of asset acquired, you take the total, from that you deduct the money received by you in the form of compensation for compulsory acquisition. Thereafter you will get WDV. If that WDV is positive, there are assets in the block, then you will calculate depreciation, there won't be capital gain. If there is no capital gain, there is no question of exemption. But if your WDV turns out to be negative, then yes, there is a short-term capital gain, then you will proceed with respect to calculation of exemption. So block information is given to in point number 1. Point number 2 says company purchased a factory building. Company purchases the factory building on 6th April 21 for 15 lakhs. See, generally no industrial house or no SSE would like to disturb his business because of compulsory acquisition. He is not going to stop his business. So what he has done, when this was compulsorily acquired, 20th April 20, this land and building was compulsorily acquired. And he has acquired another industrial undertaking on 6th April 21. Means, can I say it is acquired in next year? Next year. Compulsory acquisition happened in the year 2021. But the new building was acquired in which year? 21-22. That is in the next year. So first of all, what you have to do? You have to find out whether there is a capital gain or there is no capital gain. So you take opening WDV, add purchase, less sales, closing WDV. If that closing WDV is positive, there are assets in the block, then there will be depreciation, there won't be any capital gain. If the closing WDV turns out to be negative, then yes, there will be short-term capital gain. There will be short-term capital gain. If there is short-term capital gain, then you proceed with respect to the calculation of exemption. I am not reading the last sentence. This last sentence you ignore for the time being. This last sentence you ignore for the time being. Ignoring this last sentence, you calculate capital gain and you calculate the exemption. Solution format is given to you. On which page? 229. Not 229. 231. 231. You try this question on your own. I can give you maximum 2 minutes. Right now it is 10:04 in my watch. I can give you 2 minutes up to 10:06. If you are unable to solve up to 10:06, then we will start our discussion. Anyone of you have got what is the answer? What is the amount of short-term capital gain? This 18 lakhs, 18 lakh 65 is before exemption or after exemption? This 18 lakh 65 which you are giving me is before exemption or after exemption? Before exemption. Let us proceed now. Case A. You help me out with the numbers. The new building is acquired on 6th April 21. This is the first case. New building is acquired on 6th April 21. This is the first case. Here we say since the asset transfer is part of block asset, we have to first check whether section 32 depreciation is applicable or there will be capital gain as per section 50. What is opening value of block? This opening value of block should be on 1st April 20, not 1st April 19. It should be 1st April 20. Yes. Opening value of block is what? 21,35,000. 21,35,000. Have you acquired any new asset during the year? No. Yes. Have you transferred any new? Have you transferred any existing asset? Yes, your building was compulsorily acquired. What is the amount of compensation? 60 lakhs. That is given in line number 4. So you deduct 60 lakhs, you get the WD for charging depreciation. What is that amount? 2135 minus 16. Is it 1865? 1865? How much it is? 3865. 38 lakh 65,000. This is negative amount. This negative amount indicates what? That there is a short-term gain. This format which you have followed, this is the format for computation of depreciation. So this format is not going to work. But it is okay if you calculate in this manner. Since WDV has become negative, section 32 ceases to apply and section 50 will become applicable, resulting into a capital gain of 38,65,000. So your gross capital gain is 38,65,000. From that you deduct the amount of exemption under section 54D. Yes? Tell me what is the value of new building acquired? What is the value of new building acquired? 15 lakh. This is acquired on 6 April 21. What is the amount of capital gain? 38,65,000. So what will be your exemption? 15 lakhs. So what is the taxable capital gain? 23 lakhs 65,000. 23 lakhs 65,000. Is that very, very clear? Now let's move on to the second case. Let's move on to the second case. Let us read the last line of the question. It says, does it make a difference if the factory building is purchased on 31st March 21? So now they have changed the date of purchase of new building. Earlier, what was the date of purchase of new building? 6th April 21. In other words, that was acquired in the next year, that is 21-22. If you change the date of purchase to 31st March 21, this date is forming part of your previous year 2021 itself. Sorry. So what is the consequence? Now this value of new building will also be added to the block asset. So what is the opening value of the block? 21 lakh 35,000. 21 lakh 35,000. 21 lakh 35,000 is the opening value of block. Have you acquired new asset? Yes. The new building which is acquired for claiming exemption now, that will be added to the block because it is acquired in the current year itself. Thereafter, you will deduct the amount of compensation 60 lakhs. What is your balance amount WD for charging depreciation? $2365. This is the negative amount, right? So this 23 lakhs 65,000 indicates a short-term capital gain. $2365. So this 2365 is the amount of short-term gain. You claim exemption in section 54D, purchase of new building, 15 lakhs, capital gain 2365. What is the exemption? 15 lakhs. What is your taxable capital gain? 8,65,000. Now, can you tell me in case number 2, your capital gain has reduced or it has increased? In case number 2, your capital gain has reduced or it is increased? Reduced. Reduced by what amount? In case number A, your capital gain, taxable capital gain was 2365. Right now it is 865. It is reduced by 15 lakhs. It is reduced by 15 lakhs. So what is the moral of the story out of this question now? Out of this question, what is the moral of the story? Moral of the story is, in case of compulsory acquisition, if you acquire the new asset, in the same year in which you have received the compensation, if you acquire the new asset in the same year in which you have received the compensation, then in that case your capital gain will be lower. But if you acquire the capital asset, if you acquire the new capital asset in the next year, in that case your capital gain will be higher. So for doing the tax planning, reducing the tax liability, what suggestion we should give to the client is you should acquire the new asset in the same year in which compensation is received. So the value of that asset will be added to the block. Thereby your short-term capital gain will reduce. Thereby your taxable short-term capital gain will also reduce. Yes, is that very clear? Yes or no? So we have completed section 54D. Now we are left with two sections, 54EC and 54F. Let's move on to section 54EC now. 54EC as usual I will be completing in a span of maximum 20 minutes. 54EC very small section, very simple section, no complications at all. In fact, it is simpler than 54 as well. So listen to section 54EC provision. See, section 54EC says you are having land and building. You are having land and building. That land and building is transferred by you. And on transfer of that land and building, long-term capital gain has arisen. Long-term capital gain has arisen. Now you have two options. Either you pay tax at 20% or you claim exemption. If you want to claim exemption, you have to acquire a new asset. In 54EC, you have to acquire bonds. You have to acquire bonds of either Rural Electrification Corporation. Rural Electrification Corporation is into the business of generation of electricity. Or you have to acquire bonds of National Highway Authority of India. National Highway Authority of India is into the business of construction of building of highways. Or you have to acquire some notified bonds. Notified bonds are bonds of Indian Railway Financial Corporation Limited. Indian Railway Financial Corporation Limited. Or bonds of Power Finance Corporation Limited. They are also notified. So basically government wants to ensure that REC, NHAI, Rural Electrification Corporation, National Highway Authority of India, Power Finance Corporation or Indian Railway Financial Corporation Limited, whenever they come out with issue of bonds, that issue should be quickly subscribed and these organizations should be in a position to raise the funds. So these funds, by making section 54EC, government has ensured that with the intention of claiming exemption and reducing the tax liability, everyone would be ready to invest money in these bonds. And once people are ready to invest money in these bonds, these organizations or these institutions which are in the highway development, generation of power, etc., to them funds will always be available. So whatever amount of funds they require, they can issue the bond and easily they can raise the funds. So for them, raising the funds would become easier and huge amount of funds will be available for development of highways and setting up the power plants. So government's intention is to ensure that these institutions would easily get the funds. With that intention, government has inserted section 54EC. So in section 54EC says, government says which asset is transferred, land and building is transferred. That land and building should be a long-term capital asset. So there is a long-term gain. For claiming exemption, you have to acquire the bonds of Rural Electrification Corporation or bonds of National Highway Authority of India or bonds of Indian Railway Financial Corporation Limited or bonds of Power Finance Corporation. What is the time limit to acquire these bonds? Time limit is only 6 months. 6 months from the date of transfer. But in case your land and building is compulsorily acquired, then that 6 months should be recognized from the date of receipt of compensation and not from the date of transfer. Now see, in other sections, government had given you more time to acquire the new asset. Here government has given you only 6 months time. Why only 6 months time? Because here you have to acquire only bonds. Acquiring bonds actually doesn't require even 6 months time. You can acquire in a span of 10-15 days only. But since sometime when you want to acquire the bonds may not be available in the market. That is the reason government has given you 6 months time. Otherwise, for acquiring the bond, even 6 months time is more than enough. That much time is not required. So government says we are giving you 6 months time to acquire the bonds. In this case, since the time span for acquiring a new asset, it is not a lengthier period like 2 years, 3 years. Therefore, government says in this section, we are not giving you an option to open a capital gain account and deposit money in that account. Because anyway, your due date of filing return is 31st of July. Even if you have sold the capital asset during previous year 2021, from the end of the year also you are having 4 months period to acquire the bond. So there is no point in giving a capital gain deposit account facility in this section. So in this section you can claim exemption only based on the actual investment. There is no option of depositing money in the capital gain account. Is that clear? So once you have acquired the bonds, is there any lock-in period? Yes, there is a lock-in period. What is that lock-in period? Lock-in period is 5 years. In the earlier section, you saw that there is a lock-in period of 3 years. Here, there is a lock-in period of 5 years. If the newly acquired bonds are transferred within a period of 5 years, what will happen? If they are transferred within a period of 5 years, then capital gain will be calculated on transfer of bonds, and whatever capital gain was exempted to you on transfer of land and building, that will now become taxable. But very important point to be noted in this section is, in the earlier section, if the new asset was transferred within the locking period, then we used to calculate capital gain on transfer of new asset. And while doing calculation of capital gain, from the cost of acquisition, we used to deduct the amount of exemption claimed earlier. In other words, two things used to happen. Capital gain was calculated on transfer of new asset, and exemption which was granted to you earlier was also withdrawn. But both these calculation, both these consequences, calculation was done in a combined manner. In this section, calculation will not be done in a combined manner. In this section, two things will be segregated. Bonds are transferred, capital gain on transfer of bonds will be calculated separately. And since you have transferred the bonds within a span of 5 years lock-in period, whatever exemption was granted to you with respect to capital gain which had arisen on transfer of land and building, that exemption will be withdrawn and that amount will be kept separately. So you will have two different amounts, two independent amounts. This combined calculation will not happen in this section. In this section, we are segregating the calculation. So with this, our discussion with respect to section 54 EC is over. Now let's move on to this section and read point by point. Section 54 EC, who can claim exemption? Any person can claim exemption. See, in section 54, 54B, only individual HUF can claim exemption. Section 54D, 54 EC, any person can claim exemption. So even the company, even a partnership firm can claim the exemption. What is transferred? Land building or land and building is transferred. Nature of land and building transferred is a long-term asset. What you have to acquire? You have to acquire bonds of National Highway Authority of India, bonds of REC, or bonds notified by the central government. Which bonds are notified by the central government? That is written in note number 5. Explanation to section 54 EC has been amended to provide that investment in the bonds notified by the central government will also qualify for exemption under section 54 EC. Therefore, now bonds issued by any other bodies may also qualify for exemption. Already bonds are issued by other bodies and they are also qualifying for exemption. Those are which bonds? Bonds issued by Indian Railway Financial Corporation Limited, and Power Finance Corporation Limited. These two bonds are notified by the government. So actually now you can invest money in bonds of four institutions. Number one, bonds of REC. Number two, bonds of NHAI. Number three, bonds of Indian Railway Financial Corporation Limited. And number four, bonds of Power Finance Corporation Limited. What is the time limit for acquiring the bonds? 6 months. From which date? From the date of transfer. But in case of compulsory acquisition, from the date of receipt of compensation. What would be the amount of capital gain? Here you don't have the option to invest money in capital gain deposit account. So here the exemption will be lower of gross capital gain and amount invested in bonds within a span of 6 months from the date of transfer. Under what circumstance exemption will be withdrawn? Under what circumstance exemption will be withdrawn? Here we are saying that if the new asset is transferred, new asset means what? Bonds. If the bonds are sold off within 5 years from the date of acquisition, then exemption will be withdrawn. If the bonds are sold within 5 years, from the date of acquisition, then exemption will be withdrawn. Listen to me very carefully. Long back, only one sentence was written here. If the bonds are transferred, means sold, within 5 years from the date of acquisition, that is within the lock-in period, then exemption will be withdrawn. What few people started now? Instead of selling the bond, they went to the bank. They gave those bonds to the bank and against that bonds, they raised the loan. See, by selling the bond also you are going to get money. By giving this bond to the bank, against that if you take the loan, in that case also you are going to get money. So government says you are trying to fool us. When we have kept a lock-in period of 5 years, instead of selling the bond, you are mortgaging the bond with the bank. So ultimately our objective is defeated. Therefore government inserted few more points for the lock-in period. Now government says you cannot sell the bond within a period of 5 years. You cannot mortgage the bond with the bank and take the loan also. In any manner, you cannot convert your bond into money. If you try to convert your bond into money, then we'll say that you have sold off the bond within a span of 5 years. Exemption will be withdrawn plus capital gain will be taxable on transfer of bonds. So if new asset is transferred or it is converted into money or loan is taken on security of new asset, in that case we say that section is not complied with, exemption will be withdrawn. Taxability on withdrawal of exemption, that we need to discuss. Whether the scheme of deposit is applicable? No, it is not applicable. It is not applicable. Taxability on withdrawal of exemption, that we need to discuss. That I will discuss with you. Listen to me very carefully. Broadly, there are three different possibilities. I am discussing taxability on withdrawal of exemption in section 54 EC. What is the condition? Within a period of 5 years, you cannot transfer the bonds, you cannot convert your bonds into money, or you cannot mortgage the bonds and take the loan against the bond. What if you have transferred the bonds? What if you have transferred the bond? So I am giving you three different possibilities. One possibility, bonds are transferred within 1 year. Within 1 year. What will happen if the bonds are transferred within 1 year? Generally, all these bonds which are issued now, they are listed bonds. They are listed bonds. If they are listed bonds, what period of holding is applicable in case of these bonds? To decide whether these bonds are long term or short term, what period of holding will be applicable? Yes. 12 months. 12 months. So I am saying here, if bonds are transferred within 1 year, within 1 year, that is within 12 months, then what is consequence 1? Consequence 1, and consequence 2. What is consequence 1? Short term capital gain will be computed on transfer of bonds. Since you have sold the bonds within a span of 12 months, these bonds would be definitely listed. So it is listed securities, and since you have transferred within a span of 12 months, there would be short term capital gain on transfer of bonds. And exemption which was granted to you earlier, exemption with respect to long term capital gain which had arisen on transfer of land and building, that exemption which was granted, that exemption will also be withdrawn. So here we are writing long term capital gain will arise on withdrawal of exemption, on withdrawal of exemption. Long term capital gain will rise on withdrawal of exemption. I told you na, these two things will be kept separately. On transfer of bonds, whatever gain arises, that will be kept separately. On withdrawal of exemption, whatever gain arises, that will be taxed separately. So in this case, if the bonds are transferred within 1 year, then there will be short term capital gain on transfer of bonds, and long term capital gain which was granted, which was given to as exemption, will be taxed separately as long term capital gain. Transfer of bonds gain will be taxed as short term capital gain. Exemption withdrawal gain will be taxable as long term capital gain. Both the tax rate will also differ. Yes, have you understood this? Yes or no? Yes. So now I am moving on to second situation. If bonds are transferred after 1 year, if bonds are transferred after 1 year, but before how many years? Before 5 years. Tell me what will happen if bonds are transferred after 1 year and before 5 years? Your long term capital gain will be computed on transfer of bonds. Long term capital gain will be computed on transfer of bonds, and long term capital gain will also arise on withdrawal of exemption. Have you understood this? Yes or no? Second possibility. This you can write somewhere if you want. Where you can write now? On page number 213. On page number 213, I have kept some blank space for writing some notes. You can write this somewhere. And you can give the reference of this note. Where you can give a reference now? On page number 207, taxability on withdrawal of exemption now, you can give the reference. Have you understood now second situation? Now let's move on to third. if bonds are transferred after 5 years, what will happen? Long-term capital gain will be computed on transfer of bonds. Exempted granted earlier will be withdrawn or it will not be withdrawn? Yes? 5 years condition lock-in period is fulfilled now. So exemption granted earlier will not be withdrawn. Exemption granted earlier will not be withdrawn. Have you understood 3 different situations? Yes? So with this, our discussion with respect to section 54 EC is over. Now actually we need to move on to the most important section out of all. That is the last one, and that is section 54F. That is section 54F. Yes, have you copied this? Shall I proceed? Yes, okay. So now we need to move on to section 54F. 54F is slightly different as compared to 54, 54B, 54D as well as 54EC. The manner in which exemption is calculated is altogether different. Manner in which exemption is calculated is altogether different in 54F as compared to the earlier 4 sections. What is difference? That is what we need to understand. What is different in section 54F as compared to earlier sections? That is what we need to understand. So I am moving on to section 54F. Listen to me very carefully. Section 54F. Before I move on to this section, let me summarize all earlier 4 sections for you. Summarize means only which asset is transferred and which asset is acquired, only to that extent. In section 54, the capital asset transferred was residential house property and the capital asset acquired for claiming exemption was also residential house property. In section 54B, capital asset transferred was agricultural land and capital asset acquired was also agricultural land. Section 54D, capital asset transferred was land and building forming part of industrial undertaking. One second. You wait, let me complete. Section 54D, capital asset transferred was Land and building forming part of industrial undertaking, and capital asset acquired was also land and building forming part of industrial undertaking. Section 54 EC, capital asset transferred was land building, and what was acquired was bonds of NHAI, bonds of REC, bonds of Indian Railway Financial Corporation Limited, and bonds of Power Finance Corporation Limited. Similarly, here in section 54F, what is the capital asset which is transferred? What is transferred? Capital asset transfer is any capital asset transferred is any long-term capital asset, any long-term capital asset except residential house property, except residential house property. And what is capital asset? Acquired for claiming exemption is the residential house property. Do you recollect any other section in which exemption was available for acquiring residential house property? Yes, that was section 54. Then why there is a need of section 54F? Because in section 54, you were transferring residential house property and you were acquiring residential house property. In section 54F, you are transferring any asset other than residential house property and you are acquiring residential house property. See, for example, you are having 1 BHK flat and you want to sell off that 1 BHK flat and purchase 3 BHK flat. What you will do? The sale proceeds of 1 BHK flat would not be sufficient to acquire 3 BHK flat. So you are having two options. Option 1, you take the loan from the bank for purchasing the new flat. Option 2, if you don't want to take the loan and if you are having some other assets like gold, silver, jewelry, etc., and if you feel that let me not take loan from the bank and let me sell off these other assets and invest that money in the new property. In that case, if we don't create any other section for exemption, then what will happen? You have sold 1 BHK flat, whatever capital gain has arisen on that, you might claim exemption by acquiring 3 BHK flat. But for raising the funds, if you have sold your gold, silver, jewelry, etc., then capital gain on those assets will become taxable, na? So, with an intention to give you exemption for other assets, government came out with section 54F. So, if you are having 1 BHK flat and you are having, say for example, gold also, you are selling your 1 BHK flat and you know that sale proceeds of 1 BHK flat will not be sufficient to purchase the 3 BHK flat. So you are having gold also, you have decided to sell the gold and invest that money in new residential property for acquiring 3 BHK flat. So government says 1 BHK flat is sold, 3 BHK flat is acquired. You can claim exemption in section 54. Gold is sold and 3 BHK flat is acquired. There was no other section. Therefore, government came out with section 54F to offer you exemption when you are selling any asset other than residential house property and you are acquiring residential house property. So, this section is different as compared to section 54 in this aspect. There you are selling residential house property and you are acquiring residential house property. Here we are selling any long-term asset other than residential house property and you are acquiring residential house property. So this section is different as compared to section 54 in this aspect. Besides this, there are certain points which are similar to section 54. There are certain points which are similar to section 54. What are those similar points? For acquiring new residential house property, you have two options. Either you purchase the property or you construct the property. Purchase the property within what time? 1 year backward, 2 year forward. And if you want to construct, then within a period of 3 years forward, you complete the construction. What if once you have done the, do you have the facility of a capital gain deposit account? Yes. What if you could not purchase the property within the due date of filing return? Then before the due date of filing return, you go to a bank, open the capital gain deposit account and deposit money in that account. Then based on actual investment made plus based on whatever amount is deposited in the capital gain account, we will offer you exemption. Thereafter, we are expecting, if you have claimed exemption by depositing money in the capital gain account, then definitely we would expect you to withdraw that money from the capital gain account and utilize that money for the purpose of investment in new property. If you have not done that within a span of 3 years from the date of transfer, then on the expiry of 3 years, unutilized amount will become taxable. Unutilized amount will become taxable. Last point is, if the last point is, do you have any lock-in period for not transferring the new asset? Yes. What is that? 3 years. What if you transfer the new property within a span of 3 years? Then two things will happen. Number one, capital gain will be calculated on the transfer of new property, and number two, exemption will be withdrawn. And in this section 54F, capital gain on transfer of new property and withdrawal of exemption, these amounts will be kept separately. Independent calculation will be done, similar to what we discussed in section 54 EC. Section 54, section 54B, section 54D, combined calculation was done. While calculating capital gain on transfer of new property, from the cost of acquisition, you used to deduct the amount of exemption claimed earlier. That we will not do in case of section 54 EC and section 54F. In section 54 EC and section 54F, we will keep the long-term capital gain on transfer of new assets separately, and we will levy tax on the withdrawal of exemption separately. So these two consequences will be kept separately, amounts will be computed separately. Besides that, new residential house property, can you acquire outside India? Yes, you can acquire outside India. How many property? No, you can't acquire outside India. Means the condition is same as section 54. In section 54 also, new property you cannot acquire outside India, you have to acquire in India only. Here also in section 54A, you have to acquire new property in India. Can you acquire multiple properties, more than one house property? Answer is no. You have to acquire only one residential house property. You have to acquire only one residential house property. Here there is no relief available, which was available in section 54. Na? If the amount of capital gain is up to 2 crores, then you will be allowed to acquire new 2 properties. We will give you exemption for 2 properties. Such relief is available once in a lifetime. There is no such point in section 54F. In other words, for claiming exemption in section 54F, you have to acquire only one property. If at all you acquire 2 properties, we will take into account only one property for the purpose of computation of exemption. The property in which you have invested more amount of money, that property should be taken into account for the purpose of computation of exemption. Now, before I actually want to discuss some important aspects of this section, first of all, tell me, have you understood whatever I have explained you right now? Actually, it was not an explanation. It was not an explanation. It was just the comparison of other sections. What is there in this section and to what extent it is similar to section 54. Is that very, very clear? Yes or no? Okay. Now I will move on to calculation of exemption in section 54F. The manner of computation of exemption in section 54F is different as compared to manner of computation of exemption in section 54 and other sections. So I am going to compare 2 sections. I will be comparing 2 sections. Listen to me very carefully. I am going to do calculations and I am going to make you understand how differently exemption is calculated in section 54F as compared to all other earlier sections. Say for example, SSE has transferred gold. SSE has also transferred residential house property. For the time being, forget about the gold. Let us focus only on residential house property. Let me give you the numbers. Full value of consideration of the residential house property transferred is 1,01,000. Your expense on transfer is 1,000. So your net consideration is 1 lakh. Your index cost of acquisition and index cost of improvement is say 40,000 rupees. So your gross long-term capital gain is 60,000 rupees. Now I am going to ask a question to you. You have to give me answer. After thinking it, apply your mind, then give me the answer. Listen to the question very carefully. SSE has sold a residential house property. Let me denominate this as residential house property 1. SSE has sold residential house property 1. He is having an intention of claiming exemption on the long-term capital gain which has arisen on transfer of residential house property 1. Therefore, he is ready to acquire residential house property 2. My question is, residential house property 2 should be acquired for a minimum of how much value? It should be acquired of a minimum of how much value so that your entire capital gain which has arisen on transfer of residential house property 1 will be exempt. In other words, if SSE does not want to pay any tax, on this long-term capital gain, new property he should acquire for minimum how much value? That is the question. Yes? Have you understood the question? Yes? So I got the correct answer saying that new property should be acquired for a minimum 60,000 value. In that case, your gross long-term capital gain is 60,000, amount invested in new property 60,000, 60 or 60, whichever is lower is 60 years. That 60 will be exempted, and taxable amount will be 0. So this was the question in connection with section 54. Now, I am moving on to next example. SSE has transferred the gold. Full value of consideration is 1,01,000, expense of transfer is 1,000. As usual, same numbers. Net consideration is 1 lakh, index cost of acquisition, index cost of improvement is 40,000. So your gross long-term capital gain is 60,000 rupees. SSE does not want to pay any tax on this capital gain which has arisen on transfer of gold. For that, SSE is ready to acquire new residential house property. Question is, SSE should acquire new house property for at least how much value so that his entire capital gain on the gold is exempted from tax? Yes? Same question which I asked you few minutes back. Yes? Have you understood the question? Forget about the answer. First of all, tell me, have you understood the question or not? Yes. So listen to me. the minimum value which you should invest in new property if you want to claim exemption of the entire amount of capital gain which has arisen on transfer of gold is not 60,000 rupees, is not 60,000 rupees, but it is the amount of net consideration. What is the amount of net consideration? 1 lakh rupees, 1 lakh rupees. So you have to invest 1 lakh rupees for claiming exemption of 60,000. If you invest 1 lakh, we will give you exemption for 60,000. See, in section 54, now, in section 54, we were expecting you to invest capital gain amount. Here in section 54F, we are expecting you to invest the amount of net consideration. The net consideration is nothing but the amount of money which has come to your pocket. In section 54, look at the first column, money which has come to your pocket. It was 1 lakh 1,000. You paid the expense on time for 1,000. So what is now lying in your pocket is 1 lakh rupees. 1 lakh rupees is lying with you. Even if you acquire the new property for 60,000, your entire capital gain will be exempt from tax. Your tax liability will be zero. Still, you will be left with an amount of 40,000 in your pocket. Still, you will be left with an amount of 40,000 in your pocket. But in section 54, F, government says you have to spend the entire amount, nothing should be left in your pocket. So how much amount has come to your pocket is 1 lakh 1,000. You have incurred an expense on transfer of 1,000. So your net consideration is 1 lakh. Government says you have to invest the entire amount, nothing should be left in your pocket. In other words, for claiming an exemption of 60, you will have to invest 1 lakh. You have to invest 1 lakh. If you invest 1 lakh, we will give you exemption for 60. In other words, listen to me carefully. In section 54, we were asking you to invest the amount of capital gain. We were asking you to invest the amount of capital gain. And we were giving you exemption also for the amount of capital gain only. We were asking you to invest the amount of capital gain and we were giving you the exemption for the amount of capital gain. But in section 54F, we are asking you to invest the amount of net consideration. If you invest the amount of net consideration, we will give you exemption for the amount of capital gain. Have you understood this? Yes or no? So you have to invest how much? 1 lakh. You have to invest 1 lakh. You have to invest the amount of net consideration to get the exemption of capital gain. In other words, you have to invest 1 lakh to get the exemption of 60,000. What if you don't invest 1 lakh and if you invest 60,000? You are not investing 1 lakh, you are investing 60. Will you get exemption of 60? No. Your exemption will be proportionate amount. You just do the cross multiplication and find out the proportionate amount. That would be 36,000 rupees. So if you don't invest the entire amount will not be exempt. Question is how much will be exempt? How much will be exempt? It all depends upon the capital gain amount upon the net consideration amount. Capital gain amount is how much percentage of net consideration. Capital gain amount in this case is 60,000. Net consideration is 1 lakh. So 60,000 is how much percentage of 1 lakh? 60%. 60%. So how much will be your exemption? Your exemption will be amount invested into 60%. If you invest 1 lakh, exemption is 60,000. If you invest 50,000, exemption will be 60% of 50,000, that is 30,000. If you invest 30,000, your exemption will be 60% of 30,000, that is 18,000. If you invest 60,000, exemption will be 60% of 60,000, that is 36,000. In other words, mathematically we can say, in case of section 54, 1 rupee invested is 1 rupee exempted. Whereas in section 54F, 1 rupee invested is not 1 rupee exempted. It is something less than 1 rupee exempted. Well, how much exempted? It depends upon what is the amount of capital gain upon net consideration. But yes, in section 54F also, there can be a situation wherein 1 rupee invested, 1 rupee exempted. Means if you invest 1 rupee, exemption will be 1 rupee. When the cost of acquisition is 0. When the cost of acquisition, cost of improvement is 0, your capital gain and the amount of net consideration will remain the same. So in that case, a situation will arise wherein if you invest 1 rupee, you will get the exemption of 1 rupee. Have you understood this? Yes or no? Yes or no? Okay. Now listen to me very carefully. Last sentence I am telling you, and then we'll actually move on to section to understand the provisions. Still I need to discuss 2-3 more important points with respect to section 54F. But while I read the provision, I'll explain you. But right now, listen to me very carefully. This section 54F is the only unique section wherein exemption is calculated based on formula. Exemption is calculated based on formula. Can you tell me what is that formula? In this example, I have invested 60,000. So 60,000 is amount actually invested. Now tell me, my exemption in this example is how much? 36,000. 36,000. Can you give me the amount? Can you give me the formula to calculate 36,000? What should be the formula for calculating the exemption amount of 36,000? Yes. If I ask you, make one formula with the help of which I should be in a position to calculate 36,000. What should be that formula? Like cross multiplication is the formula. So what that formula? Derive that formula. Exemption equals to what into what divided by what? Exemption equals to, yes, Vishnu has given me the formula. Exemption equals to amount invested. Exemption equals to amount invested multiplied by capital gain divided by net consideration. Multiplied by capital gain divided by net consideration. See, question mark is exemption. The amount invested 60,000 multiplied by capital gain 60,000 divided by net consideration 1 lakh. This is the formula for calculating exemption, which is 36,000. Have you all understood this formula? Yes or no? Yes. So let me tell you the last sentence here. This is the section. Listen to me very carefully. In section 54F, formula will be used for giving you exemption. In section 54F, formula will also be used. Formula will also be used while ascertaining the taxable amount out of unutilized amount. And formula will also be used if you have transferred the new property within the lock-in period of 3 years. Formula will also be used for withdrawing the exemption. In other words, in section 54F, Everywhere you have to use the formula. You cannot ascertain any amount without using the formula. Formula has to be used everywhere. Is that very clear? Yes or no? Shall I proceed? Okay, let's move on to section 54F. In your book, page number 207 it is. There is one more important, in fact, two more important points to be discussed. They are very important, but I have not yet discussed. I will be discussing with the help of an example. So whatever I show you, that much amount only you have to read from the section. Section 54F, who can claim exemption? Individual HUF can claim exemption. What should be the nature of asset transferred? It should be long-term asset. What should be the asset transferred? Asset transferred can be any long-term capital asset other than residential house property. Asset transferred can be any long-term capital asset other than residential house property. The further part I am not reading right now. Further part provided on the date of transfer, that I am not reading right now. I will read later on. For explaining that, I will give you example also. So right now I have just read what I have underlined here. What is the asset transferred? Any long-term asset other than residential house property. What SSE has to acquire? He has to acquire only one residential house property in India. For purchase, time is 1 year backward, 2 year forward. For construction, 3 year forward. This time limit should be ascertained from the date of transfer in case of compulsory acquisition from the date of receipt of compensation. How exemption will be calculated? Formula for calculating exemption is exemption equals to amount invested multiplied by net consideration divided by, amount invested multiplied by capital gain divided by net consideration. Under what circumstance exemption will be withdrawn in the subsequent year? If the new asset is transferred within 3 years from the date of acquisition, then exemption will be withdrawn. This I have explained you. Now, or after or there is second sentence that I have not explained you till now. Next, if you transfer the new asset within the lock-in period of 3 years, what will happen? Number 1, taxability will arise on the transfer of new asset. That calculation will be kept separate. Number 2, long-term capital gain which was exempted to you earlier, that exemption will be withdrawn. Exemption will be withdrawn, then long-term capital gain amount will not become taxable. The entire amount cannot be taxed because while giving exemption we applied the formula. So while withdrawing the exemption also we need to apply the formula. Whether the scheme of deposit is applicable? Yes, a scheme of deposit is applicable. Scheme of deposit is applicable. Now I have explained you section 54F, but in this section 54F, some part is not explained. What is not explained? This part we have not discussed. This part we have not discussed. Plus remaining part, what is not underlined in this point number 3, this also we have not discussed. For discussing this, I am going to take an example. Listen to me very carefully. Example you need not copy, it is already written in note number 7. I myself will go to note number 7 only to make you understand. Now listen to me very carefully. There is one condition. For claiming exemption, there is one condition. Say for example, a person who is not owning the house, person who does not have his own house, let us say that he belongs to very poor category. Very poor category. Person who is owning one house belongs to a poor category. Person who is owning 2 houses belongs to, say for example, to middle class category. And those people who are already owning more than 2 houses now, they belong to rich category. So once again I am telling you, person not owning any house is a very poor category person. Person owning one house is a poor category. Two house is a middle class category. More than two house, rich category. Now my question to you is, should government offer any exemption to those people who are already owning more than two properties? Should we offer any exemption to them? Those people who are owning two properties, three properties, four properties, they are selling their capital assets other than residential house property and they are going and acquiring the new residential house property. So instead of paying tax, they will try to sell every asset and whatever is capital gain arisen, they instead of paying the tax, they will acquire the property. So government says those people who are into a very poor category, if that person acquires one house, then he is trying to move from very poor category to poor category. If you are not having any house, if you are selling the gold and you are acquiring the house, then you are acquiring your first house now. So you are moving from very poor category to poor category, we will give you exemption. We will offer you exemption. Second possibility, you are owning one house and now you are selling your gold and you are trying to acquire the new property. Can you claim exemption? See, if you are already owning one house and you are selling the gold and you are acquiring the second house, in that case you are trying to move from poor category to middle class category. Still government says we will offer you exemption. But third situation is, you are already owning two houses. You are already owning two houses. And now you have sold the gold and you are acquiring the third house. You are trying to move from middle class category to rich category. Government says we will not offer you any exemption. We will not offer you any exemption. See, these things they have written in some different language, in some different manner. I have just taken some example to make you understand so that you can correlate with the provision. Now let us read which language, what language government has used. SSE should transfer any long-term capital asset. SSE should transfer any long-term capital asset other than residential house property. He will be eligible for exemption provided he will be eligible for exemption provided on the date of transfer. On what date of transfer? Date of transfer of gold. On the date of transfer, taxpayer does not own more than one residential house property. I am reading this much only. Now once again something is written in bracket also that I am not reading. You just tell me what is the meaning of this. Provided on the date of transfer, SSE does not own more than one house. In other words, if he is already owning more than one house, then we are not going to offer him any exemption. Yes or no? Have you understood this? Vidyashree? Have you understood what I have tried to explain you? Yes or no? Dikshit, yes. You can own one house. You can own one house, but you can't own two houses. You can't own two houses. If you are already owning two houses, no exemption for you under section 54F. I will take an example to make you understand. See, page number 208 in your textbook, I am having the example. Example number 1, X owns following capital assets. Number 1, residential house property 1. X is owning residential house property 1. This is the long term asset. X is also owning gold. This gold is also long term asset. This gold is sold on 15th August 20. So it is sold in your previous year 2021. So on transfer, on sale of this gold, long term capital gain might have arisen. For claiming the exemption of that long term capital gain, SSE has acquired new residential house property, that is residential house property 2 on 26 January 21. Is he eligible to claim exemption? Yes, he is owning one residential house, that is RHP 1. He is owning the gold. He is selling the gold and acquiring residential house property 2. Can he claim exemption? He is owning one house and he is acquiring second house. So he is trying to move from poor category to middle class category. Can he claim the exemption? Yes. So conclusion is, since SSE owns only one residential house on which date, on the date of transfer of gold in our example. In our example, on the date of transfer of gold, since SSE is only owning one house, he is eligible to claim exemption in section 54F. He is eligible to claim exemption in section 54F. Tell me, have you understood this? Yes or no? Yes. Now let's move on to example number 2. Let's move on to example number 2. Example number 2 says, Mr. X owns following capital asset. He owns a residential house property number 1, which is a long-term asset. He also owns a gold. This gold is also a long-term asset. This gold is sold on 15th August 20. So there is a long-term capital gain on transfer of gold. He wants to claim exemption. So he has acquired new residential house property 2 on 10th August 20. Is he eligible for claim exemption in section 54F? First of all, you tell me how example 2 is different as compared to example 1. What is different in example 2 as compared to example 1? Both are same only. Do you believe that example 1 and 2 are different? If yes, in what aspect? Yes. Example 2, the date of purchase of new property is different. In example 1, the date of purchase of residential house property 2 was 26 January 21. Whereas in example 2, date of purchase of residential house property 2 is 10th August 21. In other words, listen to me very carefully. In other words, in example 1, new property was acquired after selling the gold. New property was acquired after selling the gold. Here in example number 2, new property is acquired before selling the gold. Before selling the gold, you have already acquired new property. So, on the date of transfer of gold, you are having how many properties? You are having 2 properties. Residential house property 1 as well as 2. Can you claim exemption? Yes. Why? Because in section 54F, the part which we have not read, it says, while you see whether SSE is owning more than one house property or not, this is required to be seen on the date of transfer. But while you see this, while you check the condition whether the SSE is owning more than one house property or not, this is an exception, except new house acquired for taking exemption under section 54F. Means, while you count whether the SSE is owning more than one house or not, the new house which is acquired for claiming exemption under section 54F, that should not be taken into account. You hide that new house. You remove that new house without considering new house. You see whether SSE is owning more than one property or not. Now, you go to our example number 2, in note number 7, example number 2. You have to check the condition whether the SSE is owning more than one house or not. But if you simply check the condition saying that how many houses he is owning, then you will say that he is owning 2 houses. Residential house property 1 and residential house property 2. Because residential house property 2 is already acquired before selling the gold itself. But residential house property 2 was acquired with an intention of claiming exemption under section 54F. You know that for acquiring the residential house property, 1 year backward period is also allowed now. So in this example, you have acquired residential house property 2 in that 1 year backward period. So for checking the condition whether you are owning more than one house or not, this new residential house property 2 should not be taken into account. This should not be taken into account. So ignore this residential house property 2. Now you check the condition whether SSE is owning more than one house. Answer is no. He is not owning more than one house. He is only owning one house. Is he eligible to claim exemption? Yes. So conclusion, you have written, since SSE owns only one house property on the date of transfer of gold, except the house property purchased to avail exemption under section 54F. In other words, this house property should not be taken into account except the house property purchased to avail exemption under section 54F. This in sentence which is written in the bracket is talking about residential house property 2. This residential house property 2 should not be taken into account while checking the condition whether you are owning more than one house or not. Therefore, conclusion is he is eligible to claim exemption under section 54F. So I have completed example number 2. Tell me very clearly, have you understood example 2? Only if you have understood example 1 and 2, there is a possibility that you will understand example 3. Yes? Yes? Very good. So let's move on to the last example. Example 3 says Mr. X owns following capital assets. Mr. X owns following capital assets. He is owning residential house property 1. This is a long-term asset. He is also owning residential house property 2. This is also a long-term asset. He is owning gold. This is also a long-term asset. Gold is sold on 15th August 20. By selling the gold, long-term capital gain has arisen. He doesn't intend to pay any tax. So he has acquired residential house property 3 on 26 January 21. Is he eligible for exemption under section 54F? On the date of transfer of gold, he is owning how many properties? 2 properties. While checking the condition whether he is owning more than one property or not, the new property which is acquired should not be taken into account. Which property is newly acquired? Residential house property 3. That residential house property 3 should not be taken into account. Even without taking into account residential house property 3, he is already owning 2 house property, residential house property 1 and 2. Therefore, he is not eligible for exemption. So our conclusion is, since Mr. X owns 2 house properties on the date of transfer of gold, that is 15th August 20, other than the house property acquired for claiming exemption under section 54F, Mr. X is not eligible. Mr. X is not eligible to claim exemption under section 54F. Is that very, very clear? Yes or no? Yes. Now let me ask you a question. See, now question which I am asking you, the question which I am asking you is a tax planning question. It is a tax planning point. Definitely related to CA final, not an intermediate, but I am still asking you if you can understand, it is great. In this example number 3, if SSE says that I want to claim exemption under section 54F, say for example your client has come to you, and that situation, your client has explained you the situation, that situation exactly fits into example number 3, and your client says, no, you are a chartered accountant. What is the point of you becoming a chartered accountant if you cannot help me out in reducing my tax liability? I want to claim exemption in section 54F. Come what may, I will claim exemption. You tell me how to claim. What you will say? No, you can't claim. Will that be your reaction? If yes, then what tax planning you can do for your client? Just filing the income tax return of your client is not sufficient. You have to ensure that your tax liability for a client is lower. So what advice you would give to your client so that he is able to claim exemption in section 54F? You also know that he is not eligible to claim exemption under section 54F. But what advice you would give to your client so that he becomes eligible? You make him eligible to claim exemption under section 54F. For that, what suggestion you would give? Yes, Dikshit has given me the answer. So, very good. Parvez has also given the same answer. So, we will ask the client to sell either residential house property 1 or residential house property 2. Ask him to sell one of the house property before selling the gold. So here he is owning two properties, residential house property 1 and 2. He is having intention of selling the gold and acquiring the residential house property 3. Ask him to do one thing. Ask him to sell either residential house property 1 or 2. Whichever is smaller, ask him to sell that one property out of 2. Then ask him to sell the gold and let him acquire the third property which is very big. So in that case, on the date of transfer of gold, if before the date of transfer of gold, he sells either residential house property 1 or residential house property 2, then on the date of transfer of gold, he will be having only one property. Then he will become eligible for claiming exemption in section 51F. But in that case, an actual question would arise, sir, if he sells residential house property 1 or 2, in that case, residential house property 1 or 2, whichever he sells now, there also there will be a capital gain na. That capital gain you can claim exemption in section 54 then. That capital gain you can claim exemption in section 54. But you have to ensure that the new property which you are acquiring is of higher value so that you are able to claim exemption in section 54 as well as section 54F simultaneously. Yes? Have you understood? Have you understood? Vishnu has given me one suggestion saying that, sir, convert this residential property into commercial property. This is the best thing. But unfortunately, this cannot be done. See, you can't convert your residential properties into commercial properties. It is not possible. Say, for example, you are having a residential property in a very big residential tower on 20th floor. Can you convert that into commercial property? It is impossible. Number one. Number two, your housing society also will not allow that. See, old properties, now you can do whatever you want to do. On a new properties which you acquire right now, as of now, you can't convert your residential properties into commercial properties. It is not possible. See, in your residential property, if you are doing some commercial activities, that doesn't mean that your property has become commercial. You have become commercial. Your property is not commercial. Property commercial means as per the municipal record, it is commercial property. Municipal records commercial property, you have to pay more municipal tax for commercial property. Electricity bills are also higher for the commercial property. For commercial property, everything is higher. So actually you are paying municipal tax, electricity bill, etc. of the property, considering it to be residential. You can't convert it into commercial. That is not possible. Yes, have you understood this? So tax planning point I have written here. Not relevant at CA intermediate level, but yes, it is relevant. If Mr. X wants to claim the benefit exemption under section 54F, then he should sell either residential house property 1 or residential house property 2 before the date of transfer of gold. In such case, he will have only one residential house property on the date of transfer of gold and he will become eligible for claiming exemption under section 54F. Yes. Have you understood this very clearly? Yes or no? With this, our section 54F is also over, but in that one point is left. One point is left. What is that point now? In earlier sections, you had a restriction. New property which you are acquiring now, there is a lock-in period of 3 years. Here, there are two conditions. Once you have claimed exemption in section 54F by acquiring the new property, the first restriction is lock-in period. You cannot sell the new property within 3 years. And the second condition is very important. In the next 3 years, listen to me carefully, in the next 3 years, you cannot purchase or construct any other additional property also. In the next 3 years, you cannot purchase or construct any additional property. In other words, once you have claimed exemption in section 54F, the property which was acquired for claim exemption in section 54F, that cannot be sold within 3 years. And during that 3 years also, you can't acquire any other property. So inflow of property is restricted, outflow is also restricted. No outflow, no inflow for the next 3 years. So, if another residential house property is purchased or constructed within 2 years or 3 years, then exemption granted to the SSC will be withdrawn. If SSC is purchasing or constructing another residential house property within 2 years, 3 years. See, if SSC is trying to purchase or construct another residential house property after claiming exemption in section 54F, meaning thereby he is trying to move from middle class to rich category. The moment he tries to move from middle class to rich category in the next 3 years also, we will slap him. We will withdraw this. We will withdraw his exemption. Is that very, very clear? Why 2-3 years? 2 years for purchase and 3 years for construction. Dikshit, 2 years for purchase and 3 years for construction. The word 2 years should be read along with purchase word and 3 years should be read along with construction. So this we have completed. Now we are having question number 18, practical question on section 54A. But I think it is the time for having a break for you. Correct? Or do you want me to complete this question and then have a break? Yes? I think if we complete this, it will be better. Because after the break, then we can move on to an altogether different topic. After the break, we can move on to altogether different topic. Otherwise, after the break, we'll be confused. We'll have to solve question number 18, then we'll have to discuss the tax rates. So we'll complete this question. Very small question. But you need to remember that in section 54F, you have to apply the formula. Without formula, nothing is possible in this section. So question number 18 says, Mr. M has sold the gold on 16 July 20 for a sum of rupees 45 lakhs. This sum of rupees 45 lakhs is a full value of consideration. Your capital asset, gold is a capital asset belonging to third category. Period of holding applicable is 36 months. 16 July 20 is the date of transfer which falls into your previous year 2021. The gold was purchased by him in 1995, means it was purchased prior to 1st April 2001. Examiner should give you fair market value on 1st April 2001. It was purchased for 8 lakhs. Fair market value of gold is 12 lakhs on 1st April 2001. So 8 lakhs, 12 lakhs, whichever is higher, 12 lakhs will be taken into account for the purpose of computation of capital gain. He spent a 2 lakh till 31st July 2021. That is the due date of filing return on construction of house property. He has actually spent a 2 lakh for construction of house property and he has deposited 5 lakhs on 30th June 21 under the capital gain scheme. Do you believe this 5 lakh is eligible for exemption? Yes, because it is deposited in the capital gain account within the due date of filing return. And he has further deposited 1 lakh 50 on 30th August 21. 30th August 21 is after the due date of filing return. So this 1 lakh 50 will not be taken into account for the purpose of computation of exemption. Further it says, he withdraw from the capital gain account a sum of rupees 4 lakh for construction of house till the stipulated time. In other words, can you tell me what was the amount deposited in the capital gain account? Yes? First installment he has deposited how much? 5 lakhs. 5 lakhs. Second installment he has deposited 1 lakh 50. But that 1 lakh 50 is deposited after the due date of filing return. That will not be taken into account for the purpose of computation of exemption. What will be taken into account for the purpose of computation of exemption is only 5 lakhs. Now the point is, listen to me very carefully. I am asking you the most important part of the entire question. How much is the unutilized amount? How much is the unutilized amount? Can you tell me how much is unutilized amount? Yes. What was deposited in the capital gain account is 5 lakh plus 1 lakh 50, that is 6 lakh 50. Out of 6 lakh 50, the amount which was taken into account for the purpose of computation of exemption was only 5 lakhs. Out of that 5 lakhs, what is actually utilized for Computation of exemption. Sorry, out of that 5 lakh, how much amount is utilized within the span of 3 years? 4 lakhs. So what is the balance left? 1 lakh. Now my question to you is, how much amount will become taxable? How much amount will become taxable? Do you believe that 1 lakh will become taxable? Yes or no? Have you understood the question first of all? If you have not understood that, then I'll discuss along with the solution. You tell me the answer. 1 lakh will become taxable, or more than 1 lakh will become taxable, or something less than 1 lakh will become taxable. What will become taxable? More than 1 lakh cannot be taxed. It is impossible. So either 1 lakh will be taxed or something less than 1 lakh will be taxed. So Varshini says less than 1 lakh will be taxed. Why so? Because for calculating the taxable amount, you have to apply formula. You have to apply formula. Therefore, something less than 1 lakh will be taxed. But how much amount will be taxed? That I do not know right now. Because that formula needs to be applied. You have to first of all ascertain the amount of capital gain, ascertain the amount of net consideration. Then only you can come to know how much amount needs to be taxed. Compute the capital gain chargeable to tax on this transaction for various assessment years. Various assessment years. Why they are asking various assessment years now? In the previous year 2021, you calculate the capital gain. Thereafter, on the expiry of that 3 years period, the unutilized amount will become taxable. Na? So in that year, you have to calculate what is the unutilized amount, and you have to tell out of the unutilized amount how much amount will become taxable. So let us proceed to solve this question very quickly. Solution format is given to you on page number 232. 232. Previous year 2021, assessment year 21-22, statement showing taxable long-term capital gain. Period of holding of property is from 1995 to 16 July 20. But you have to take 1 day prior to that. What is the full value of consideration in this case? 45 lakhs. 45 lakhs is your full value of consideration. Your expense on transfer is 0. So your net consideration is 45 lakhs. Index cost acquisition. What is your cost of acquisition? 8 lakhs. What is FMV on 1st April 2001? 12 lakhs. So we'll take into account 12 lakhs. 12 lakhs into index number of the year of transfer 301. This is index number for the year 2021. Divided by index number of the year of acquisition or base year 1, 2, whichever is later, 100. Yes, 36 lakhs 12,000 should be the amount of index cost acquisition. 36 lakhs 12,000. What is the amount of gross long-term capital gain? 45 lakhs minus 36 lakhs 12,000. 8 lakhs 88,000. 8 lakhs 88,000. Now let's move on to calculate the exemption under section 54F. See, till this point of time, now it should be a very simple question for you. No challenge in calculating capital gain. Exemption under section 54F. Construction of house property. You tell me how much amount is actually utilized? He spent 2 lakhs for construction of house up to 31st July. So he has spent 2 lakhs. How much amount is deposited in the capital gain account within the due date of filing return is 5 lakhs. How much amount is deposited in the capital gain account after the due date is 1 lakh 50. This 150 will not be taken into account because this is deposited in the capital gain account after the due date of filing return. So what is eligible investment is 7 lakhs. In all other sections, 54, 54D, 54B, 54EC, in all other sections, your amount of capital gain exempt would have been 7 lakhs. But here, your exempt amount of capital gain would not be 7 lakhs. You have to apply the formula. Amount invested is 7 lakhs. Multiply by the amount of long-term capital gain, 8 lakhs. 88,000 divided by net consideration 45 lakhs. Yes, tell me, by applying the formula, what is the amount of exemption you have got? 138, 133. 138, 133 is the amount of exemption. I am not calculating. I don't have calci also. You should give me the right answer. 138, 133. Yes. Okay. Now tell me the taxable amount of capital gain. 8,88,000 minus 138, 133 is 749, 867. 749, 867. Yes. Shall we proceed? So previous year 2021, assessment year 21-22, capital gain calculation, exemption calculation is over. Now you tell me what is the date of transfer? 16 July 20. Whatever amount you have deposited in the capital gain account that is required to be withdrawn and it is required to be utilized for acquiring the new property within a period of 3 years from the date of transfer. If you don't utilize on the expiry of 3 years, unutilized amount will become taxable. So can you tell me on which date the period of 3 years would expire? 3 years from this 16th July 20 will be 15th July 23. 15th July 23 will fall in which year? 15 July 23 falls in previous year 23-24, corresponding assessment year 24-25. What is the amount deposited in the capital gain account? 6 lakhs 50. 6 lakhs 50. See, actually in this solution, in this statement, I should have inserted one more sentence. The amount deposited on the capital gain account is 6 lakh 50. Now you insert one more sentence there. Here between these two lines. Somewhere you write, you can take it to top margin. I am writing here amount considered. Considered means taken into account while computing exemption. I am not saying amount exempt, I am saying how much amount was considered while computing exemption. Amount deposited is 6 lakhs 50, but what was taken into account for computing exemption is 5 lakhs. 5 lakhs. That 5 lakh I am writing here. Five lakhs. Now tell me what is the amount utilized? 4 lakhs. Yes or no? Amount utilized is 4 lakhs. So what is the balance amount? 1 lakh. Do you believe this 1 lakh will be taxed? If yes, then you should have taken a break earlier only. What will become taxable out of this 1 lakh? You have to apply formula. Amount unutilized 1 lakh into capital gain 8 lakhs 88,000 divided by net consideration 45 lakhs. Yes, so the taxable amount is 19,733. 19,733. Yes, have you clearly understood this? Yes or no? So, now we'll have a break. Within 1 minute we'll have a break. How many sections we have done in exemption? First was section 54. Second was section 54B. Third was section 54D. Then we had section 54 EC. And the last one was section 54F. See, generally I give something to remember the section, but that is in Hindi. I do not know what you will understand, but I am trying to give you that. If you understand, that is okay. If you don't understand, you mug up the section numbers. Number is same everywhere. Section 54. Section 54 is exemption for what? For selling the residential house and buying the residential house. The house means what? House is made of how many walls? Residential house, any house is made of how many walls? 4 walls. Within that 4 walls there is a human being, na? His body is made of how many components? Your body is made of how many elements? 5 elements, na? Earth, water, fire. Yes or no? I will not teach you science. Your body is made of 5 elements. So, body made of 5 elements is within 4 walls. Body made of 5 elements is within 4 walls. Section 54. 54B. In agriculture, na, we use bullock cart, na, bullock cart. In agriculture, for digging the land, we use bullock, na. So B for D. D is what? Section 54D is compulsory acquisition. Compulsory acquisition means government is forcefully acquiring your asset. In Hindi we say they are doing dadagiri. Dadagiri. Do you understand dadagiri? No. Dadagiri means forcing you to sell your property. Sometime if you don't, say for example, there is some redevelopment project going on, builder will force you to sell your property, na? So in Hindi we use the word dadagiri. 54 EC, you get exemption for investing money in bonds. Bonds of REC, NHAI, IRFCL, PFC, etc. REC is nothing but an electricity company. So you invest money in the bonds of electricity company, and 54F is the only section where you use the formula. So with this, we have completed the exemption of capital gain. Now what is left in this chapter is only discussion of tax rates. Discussion of tax rates and one practical question. Besides capital gain calculation in case of a non-resident person or foreign company, that capital gain is required to be calculated in a foreign currency. That point is left, on which we have question number 23 in your book. So 2 concepts are left, plus that amalgamation demerger you read, amalgamation demerger. Yesterday I gave you no homework. Amalgamation demerger. Yes. Okay. So now let's move on to discuss the tax rates. This is the last part of the chapter. See, when we started the subject, we started with basic concept chapter. In that basic concept chapter, I had discussed with you different tax rate applicable to different persons. Those were the tax rates which are given in the Annual Finance Act. But besides the Annual Finance Act, we also have certain tax rates which are already given in the Income Tax Act itself. So today we are going to discuss those tax rates. Those are with respect to taxability of capital gains. Now you know that capital gain is taxable, and capital gain can be either long-term gain or short-term gain. For charging tax on long-term gain, we have two sections. One is section 112, the other one is section 112A. And for charging tax on short-term gain, we have one special section, that is 111A. Those short-term capital gain which do not fall into section 111A would be taxable at normal rates. So in your textbook on page number 214, I have combined all the sections, section 112, section 112A as well as section 111A. Everything is combined here, and a flowchart is made on page number 214. This flowchart is basically a summary of different tax rates. Those tax rates are explained to you right from page number 210 to page number 213. There are 4 pages explaining you the tax rates. Those 4 pages are summarized into one page on page number 214. So you can move on to page number 214 and we'll quickly go through the tax rates. Now, we have two types of capital gain, that is long-term capital gain and short-term capital gain. For charging tax on long-term capital gain, we have two sections. One is section 112, the other one is section 112, the other one is section 112A. First of all, we are moving on to section 112A. What it says, which capital gain, which long-term capital gain will be taxable as per section 112A. It is long-term capital gain arising on transfer of number 1 listed equity shares and number 2 units of equity oriented mutual fund or units of business trust. See, what do you mean by business trust? You do not know. In CA final, we have a separate chapter called as taxability of business trust. So right now you forget about it. You just remember two things. Number 1, long-term capital gain arising on transfer of listed equity shares, and number 2, long-term capital gain arising on transfer of units of equity oriented mutual fund. In case of listed equity shares, if you have paid securities transaction tax on purchase as well as sale of such shares. And in case of units of equity oriented mutual fund, if you have paid the securities transaction tax at the time of sale. In that case, we are saying that the tax rate is at flat rate of 10%. So slab rate will not apply to this capital gain. Capital gain will be taxable at flat rate of 10%. Number 2, see, number 2 is not relevant at CA intermediate level. You may not understand. I am just reading. If you have understood, that is excellent. If you don't understand, that is okay, because that is covered at CA final level. Long-term capital gain arising from a transaction undertaken in a recognized stock exchange. This much you might have understood. This stock exchange is located in International Financial Service Center. There is a place called as IFSC, International Financial Service Center. Government of India had a target of, government had decided to make India as a financial hub. So they decided that we will create International Financial Services Center. In those International Financial Services Center, non-resident people can trade on a stock exchange using the foreign currency. Such kind of international financial service centers were planned in India. Till now, no plan is executed. So as of now, you don't have any international financial service center right now. But in Gujarat, they have a, recently just before 6 months, Government of India has given the approval for setting up the first international financial service center in Gujarat. So as of now, we don't have this. But if you have undertaken a transaction through International Financial Service Center, where the consideration is received or receivable in a foreign currency, then even though STD is not paid, see, any transaction carried out through stock exchange located in International Financial Service Center, on that stock exchange, if you carry out a transaction, there is no securities transaction tax at all. So here we say that if even though STD is not paid, on that gain tax rate will be 10%. From your examination perspective, point 2 is not important. Only point 1 is important. You just remember point number 1. So I am repeating section 112A for you. What it says? If you have got a long-term capital gain, long-term capital gain on transfer of equity shares or units of equity-oriented mutual fund, if the sale transaction is done through stock exchange and securities transaction tax is paid, then that long-term capital gain will be taxable at 10%, and that too we are offering you a relief of 1 lakh rupees. In other words, if you are having a long-term capital gain of 5 lakhs, then 1 lakh will not be taxed. Amount in excess of 1 lakh only will be taxed. So if you are having a long-term capital gain of 5 lakhs, then 1 lakh will not be taxed. Only excess 4 lakh will be taxed at 10%. So your tax liability will be 40,000 rupees. So long-term capital gain in excess of 1 lakh will be taxed. Plus the long-term capital gain which is covered in section 112A, that will be calculated without indexation benefit. That will be calculated without indexation benefit. See, this is the concessional rate of tax offered by the government. So on one hand, government is giving you concession, saying that we will levy 10% tax. Normally, in case of long-term gain, 20% tax is levied. But here in section 112A, government is offering you concessional rate of tax. Therefore, government says we are not going to give you the benefit of indexation. So first of all, this capital gain is required to be calculated without taking indexation. Whatever amount of capital gain is arrived, first 1 lakh will not be taxed, balance will be taxed at 10%. Now here in section 112A, there is something called as grandfathering clause. There is something called as grandfathering clause. What is that grandfathering clause? That we'll understand later. First of all, right now, let us focus only on tax rates. Grandfathering clause is followed for computation of capital gain. So capital gain will be calculated by applying the grandfathering clause. What it is, why it was introduced, all these things we'll understand later. Right now, our focus is to understand just the tax rates. So this section 112 is over. Now I am moving on to section 112A. Section 112A. See, all capital gain is not covered by 112A. Now I am moving on to section 112. But every capital gain is not covered by 112A. What is covered by 112A is long-term capital gain arising on transfer of listed equity shares or long-term capital gain arising on transfer of equity-oriented units of equity-oriented mutual fund. What about other long-term capital gain? Long-term capital gain on transfer of land, building, jewelry, archaeological collection, drawing, painting, sculpture, work of art, bullion, etc. All that capital gain will be taxable in section 112. 112A will not apply. 112 will apply. So we move on to section 112. In 112, we are saying that if the long-term capital asset which is transferred is unlisted securities or shares of a closely held company. Unlisted securities or shares of a closely held company. Shares of closely held company means private company. Closely held company means private company. See, shares of private company are always unlisted. And shares of closely held public company. Closely held public company means having very few shareholders. Those shares can also be unlisted. So, if the asset which is transferred, if the capital asset which is transferred is a unlisted securities or shares of a closely held company, in that case, if the SSC is a foreign company or a non-resident person, if the SSC is a foreign company or non-resident person, tax rate would be 10%. Tax rate would be 10% without indexation benefit. In other words, benefit of indexation will not be given, and without giving the benefit of currency fluctuation. What is this benefit of currency fluctuation is yet to be discussed. We have question number 23 based on that. So accordingly we will discuss that. So right now you remember that if the capital asset transferred is number one unlisted securities or shares of closely held company, and if the seller, transferor, SSE is a foreign company or non-resident person, then indexation benefit will not be given. Currency fluctuation benefit will also not be given, and that capital gain will be taxable at flat rate of 10%. This is also a concessional rate of tax. What if SSE is other than non-resident person? SSE is the resident person. SSE is not a foreign company. Then in that case tax rate will be 20% and you will get the benefit of indexation. So in case of all resident persons, tax rate would be 20%, and while calculating such capital gain, you can take the benefit of indexation. Now we move on to the second part. We are still in section 112. We are in second part. It says if the capital asset is listed securities other than units. Capital asset is what? It is listed securities except units. See, listed securities were not covered by the first category. The first category, listed securities, is not covered. Second category, we have listed securities except units. And number two, we have zero coupon bonds. If there are units, then they are not covered by category 2. Either if there are units, they will be covered by, if they are equity oriented, they will be covered by category 1. If they are debt oriented, they will be covered by category 3, residuary category. Units are not covered by second category. So, listed securities other than units, and zero coupon bonds. Government has given you option. If you want to take the benefit of indexation, tax rate will be 20%. If you don't want indexation, then tax rate will be 10%. Now the question is, which tax rate will be more beneficial? 20 will be more beneficial or 10 will be more beneficial? This you cannot see in absolute terms, because you have to see indexation also. So you have to calculate the amount of capital gain twice. First, on first instance, you will calculate capital gain taking the indexation. So you will get the index cost, then you get the amount of capital gain. On that you apply the tax rate at 20%. And then you calculate capital gain without taking indexation. You just deduct the cost of acquisition, you get the amount of capital gain. On that you apply 10% rate. So you will have two tax amounts. Tax amount on the amount of capital gain which is calculated after taking the benefit of indexation. And second will be the tax amount on the amount of capital gain which is calculated without taking the benefit of indexation. Wherever the tax liability is less, you should go for that option. Wherever the tax liability is less, you should go for that option. But very important point to be noted. Listen to me carefully. This point is not covered by me earlier. Very important point to be noted is, in case of bonds and debentures, In case of bonds and debentures, indexation benefit is anyway not available. Till now we have solved a lot of sums, but in any of the sums, there was no debentures, there was no bonds. Now we will be solving one sum, that is question number 19. In that we have debentures and bonds. So I am telling you right now that in case of bonds and debentures, you don't get the benefit of indexation. That is written in the table of indexation itself. So I will take you to the table of indexation, and there you can mark that point is very important. In your book it is page number 176. In your book it is page number 176. So right now I am moving on to page number 176 to show you that note. See, this is the table of indexation. Point number 1, 2, 3 was covered. Point number 4, part 1 and 2 was covered. Now part 3, 4, 5 is also covered. CIT versus Manjula Shah is also covered. Point 5 is covered. Point 6 was not covered. It is not covered. So now we will refer to point 6. What it says? If the asset is a long-term asset, normally indexation is allowed. Normally indexation is allowed. See, if the asset is long-term asset, normally indexation is allowed. So if the asset is long-term asset, normally indexation is allowed. But in case of bonds and debentures, indexation is not allowed. So if the long-term asset is either bonds or debentures, then indexation benefit is not allowed. So listen to me carefully. If the asset is other than bonds and debentures, indexation is definitely allowed in case of long-term asset. But if the asset is bonds or debentures, you won't get the benefit of indexation. Question is why? Because indexation is compensation for time value of money. And in case of bonds and debentures, you already get the interest now. In case of bonds and debentures, you already get the interest at fixed rate of interest. So already you have received benefit of time value of money. So government says in case of bonds and debentures, we will not give you indexation. But to this point also, there are certain exceptions. There are certain exceptions. Which are those exceptions? Given on the right hand side. In case of following bonds, indexation will be allowed. Which bonds? Capital indexed bonds issued by central government and sovereign gold bond issued by RBI. Sovereign gold bonds issued by RBI. So I am repeating this for you. Listen to me carefully. Number 1, for any capital asset which is long-term capital asset, it is neither bond, it is not debentures. So any long-term capital asset other than bonds and debentures, indexation will be allowed. This is point number 1. Point number 2, in case of bonds and debentures, indexation will not be allowed. Point number 3, however, in case of capital indexed bond issued by central government and in case of sovereign gold bond issued by the RBI, indexation benefit will be allowed. Is that very, very clear? Yes or no? Yes? Have you understood this very clearly? Intentionally, I did not cover this point. See, in entire chapter, we have solved so many questions. We did not come across this point. So, intentionally, I had not covered. So, I am covering this along with the tax rates. So, now if you refer this second category of section 112. It says what? Listed securities other than units, zero coupon bonds. Tax rate will be 20% with indexation or 10% without indexation, whichever is beneficial to assessing. Let him decide whichever is beneficial. But at the same time, you have to also refer to the point which I explained to you right now, saying that in case of bonds and debentures, indexation is not allowed. So in case of these zero coupon bonds, anyway indexation is not allowed. So that option of 20% with indexation is not valid for zero coupon bonds. Is not valid for zero coupon bonds. For zero coupon bonds, you have to go for 10% without indexation only. So this 20% with indexation, 10% without indexation, this option will be available for listed securities other than units only. For zero coupon bonds, you have to go for 10% without indexation, because anyway in case of bonds, indexation is not allowed. Deva is asking me, sir, gold bond is not a capital asset, na? Just now we told that in case of sovereign gold bond, indexation will be allowed. But gold bond is not a capital asset. Deva, gold bond I have not done detailed discussion with you, because it is not important that CA intermediate level. But now since you have asked me the question, let me tell you that recently bonds were issued by the government of India in the year 2015. There are two things. Number one is gold deposit bonds. Gold deposit bonds. This gold deposit bond is not a capital asset. And these gold deposit bonds are issued by the central government. And we also have something called as sovereign gold bonds. We also have something called as sovereign gold bonds. These are issued by RBI. And these are capital assets. These are capital assets. So what is not a capital asset is gold deposit bond, wherein central government will issue the bonds to you and you have to give your gold to the central government. Whereas in case of sovereign gold bonds, these are issued by RBI, and in this case you are giving money to the RBI. You are not giving gold to RBI, you are giving money to RBI. These bonds are different. Gold deposit bonds are different and these bonds are different. Yes? Have you understood, Deva? So at the time of redemption of this sovereign gold bonds, yes, tax will be levied. This is not a capital asset, so no capital gain. This is a capital asset, so capital gain will arise. So I am moving back to same section 112. First category I told you, in case the long-term asset is unlisted securities or shares of a closely held company. If the assets is a foreign company or non-resident person, 10% tax rate without indexation, without the benefit of currency fluctuation. In case of other assets, 20% tax rate with indexation. Number 2 category, if the long-term asset is listed securities other than units or it is zero coupon bonds, then 20% with indexation, 10% without indexation, whichever is more beneficial to SSC. But in case of bonds, anyway indexation is not allowed. So zero coupon bonds, it is always 10% without indexation. It is always 10% without indexation. And then we have the third category, which is a residuary category, if the long-term capital asset is any other asset. If the long-term capital asset is any other asset. So means land and building, equity shares, right shares, bonus shares, jewelry, archaeological collection, drawing, painting, sculpture, work of art, bullion, everything will form part of this third category. If those are long-term asset, then tax will be 20% with indexation benefit. Tax will be 20% with indexation benefit. Yes, have you understood this? Tax rates, we have discussed the section 112A. We have also discussed the section 112. So long-term capital gain tax rates are over. Now we move on to tax rates of short-term capital gain. Tax rates of short-term capital gain. Short-term capital gain in section 111A, short-term capital gain is taxed at flat rate of 15%. This I am copying from section 112A. Now 112A, whatever is the content now, I am copying here. Just I am replacing the word long term by short term. And new section is coming, section 111A, where the tax rate is flat rate of tax 15%. Let us read this once. Short term capital gain on transfer of listed equity shares, units of equity oriented mutual fund, units of business trust, sale transaction is done through stock exchange and securities transaction tax is paid. So it is same copy to copy taken from section 112A. Short term capital gain arising on transaction undertaken in a foreign currency in a recognized stock exchange located in International Financial Service Center, even though STT is not paid. Anyway, any stock exchange which is located in International Financial Service Center, there is no STT in that stock exchange. So there is no question of paying STT. I already told you this point number 2, not relevant at CA intermediate. Besides that, you just remember point number 1. If the short term capital asset is listed equity shares or units of equity oriented mutual fund or units of business trust, sale transaction is done through stock exchange, STT is paid. If it is long term, it is covered by section 112. You pay tax at 10%, don't take the benefit of indexation. If it is short term, it is covered by section 111A, you pay tax at 15%. And in short term, anyway you don't get the benefit of indexation. Other short term capital gain will be taxable at normal rates. Other short term capital gain will be taxable at normal rates. What do you mean by normal rates? In case of individual HUF, association of person, body of individual, artificial juridical person, slab rates. In case of company, flat rate 30%. In case of firm, flat rate 30%. Normal rate means whatever we had discussed in the chapter of basic concept. In the chapter of basic concept, I had explained to you that tax rates we can divide in 2 parts. Normal rates of tax, special rates of tax. So all these are special rates of tax. Yes? Have you understood? Now this flow chart, next page I have summarized the flow chart. I have summarized and 2-3 more important points are inserted here. But before we actually move on to understand this, I want to explain you section 112A in detail. See, this section 112, you only refer at home. I don't want to explain you. Section 111A, you only refer. I have already explained from my side. Whatever points are left will be explained right now. But I don't want to read in the class. I don't have that much time that I should read each and every line. You will understand, you refer this at home. I will explain. I will not read. So section 111A, what is section 111A? 111A. Short-term capital gain arising on transfer of equity shares, units of equity oriented mutual fund, units of business trust, sale transaction is done through stock exchange, STT is paid. What is the tax rate? 15%. That is what is section 111A. Section 112, I have already explained you. Same things, I don't want to read once again. So you can refer this at home. Meaning of listed securities, etc. is given. But I want to discuss section 112A in detail because this section was introduced in assessment year 1920. Now listen to me very carefully. See, if you are having equity shares, or you are having units of equity oriented mutual fund, or you are having units of business trust. If the sale transaction is done through stock exchange, and security transaction tax is paid. Security transaction tax is paid. Then up to assessment year 18-19. Up to assessment year 18-19 means previous year 17-18. Long term capital gain was totally exempt. It was totally exempt under section 10 clause 38. It was exempt where? Section 10 clause 38. This section is already deleted. I am just giving you the background to understand what is section 112A, why it was introduced, what is grandfathering clause, why there was a need to insert a grandfathering clause. That is what I am trying to explain you. So I am giving you the background to understand. So if you have an equity shares or units of equity oriented mutual fund or units of business trust, you sell this through stock exchange and you pay the STT, then up to previous year 17-18 corresponding assessment year 18-19, that long term capital gain was totally exempt in section 10 clause 38. The budget 2018. Budget 2018. La budget 2018 means applicable from which year? Applicable from previous year 18-19 corresponding assessment year 19-20. Budget 2018, government came out with an amendment saying that now we are deleting section 10 clause 38. Section 10 clause 38 we are deleting. This section was removed from the Income Tax Act. This was deleted. A new section was introduced. Section 112A. Now onwards government says this long term capital gain will be taxable at the flat rate of 10% concessional rate, and you will not get the benefit of indexation also. So what was happening earlier? The long term capital gain which was exempt in section 10 clause 38 was now being made taxable. And this budget 2018 is applicable from which date? Is generally applicable with effect from 1st April 18. This budget would come on which date? Yes, this budget would get introduced on 1st February 18. Yes, this budget would be introduced on 1st February 18, would be generally made applicable with effect from 1st April 18. Now my question to you is, on 1st February 18, if government says that from next year onwards, with effect from 1st April 18, the long term capital gain which is exempt to you is going to become taxable to you. If government announces this, then what people will do? Will people wait for 1st April 18 to arrive? Definitely not. What they will do? The moment this announcement is made they would try to sell their shares and book the long term capital gain and take the advantage of section 1038. Because section 1038 is there now. Section 1038 will be deleted with effect from 1st April 18. So the moment it was announced on 1st February 18 that long term capital gain will be taxable, if that is announced and you have 2 months time, it will be made taxable with effect from 1st April 18. In that case, everyone would try to sell the shares. There will be huge selling pressure in the market. There will be huge supply of shares in the market. Demand remaining at the same level. Prices will fall down like anything. To prevent markets from falling. See, because of this amendment, if the investors start selling these shares in the market and the demand remains at the same level, prices will fall drastically, market will come down. So, to prevent market from falling drastically, government came out with a grandfathering clause. Government came out with what? Government came out with a grandfathering clause in budget 2018. Government inserted a grandfathering clause. This word grandfathering clause was used by the finance minister in the budget speech. The entire country was not knowing this grandfathering word earlier. On the day of the budget, once the budget speech was over, most of the people were searching what is grandfathering clause in Google. Thereafter, budget document was released and then people went through the grandfathering clause and they realized that grandfathering clause means whatever long-term capital gain you have earned now, whatever long-term capital gain which is already accrued, whatever long-term capital gain which is already accrued up to which date? Accrued up to the date of budget. The date of budget was what? 1st February 18. What is one day prior to this 1st February 18? One day prior to this 1st February 18 is 31st January 18. So, long-term capital gain which is already accrued up to 31st January 18 now, we are not going to apply a new section on that. In other words, we will offer you exemption. For example, your cost of acquisition of shares is say 100 and on 31st January 18, the price of this shares is say 250. So can I say you already have a capital gain of 150? You already have a capital gain of 150 on the date of announcement of budget na? Government says you will not get exemption and we will levy tax, then what you will do? We will go and sell shares in the market, book your capital gain and claim exemption. But government did not want you to sell the shares because market will fall down. So, for preventing people from selling the shares, government came out with a grandfathering clause saying that you do one thing, whatever gain is already accrued now. What is already accrued? 150. This 150 we will not levy tax on this 150. You don't sell the shares right now. You sell it in future whenever you want to sell. But you take it from us saying that this 150 we will not tax in future. In other words, in future, whatever capital gain arises, from that capital gain, we will remove 150. And if you are having capital gain in excess of 150, then only we will levy tax. In other words, your capital gain which was already accrued to you, taking into account the market price on 31st January 18, that capital gain was kept aside. It was safe, kept in a safe vault, saying that this will not be taxed in future. So, this is called as grandfathering clause. By inserting grandfathering clause, what government has ensured? In a hurry, people should not sell the shares. Whatever capital gain they are already having, we will not levy tax on that. Whatever capital gain will now arise, only that will become taxable. This was the purpose of inserting the grandfathering clause. Have you understood this? Definitely I am going to take examples to make you understand. But have you understood what is this grandfathering clause? Yes. So grandfathering clause in one line. What is grandfathering clause? Whatever gain is already accrued to you, whatever gain is already earned by you up to 31st January 18, that gain you lock it. We will not levy tax on that gain in future. If in future you sell the shares, you earn something extra over and above gain already earned by you up to 31st January 18, only that gain will be taxed in future. So here I have taken 4 different cases to make you understand the grandfathering clause. See here, this is an example. This table, listen to me carefully. This table is an example. This table is an example. The second table is for understanding the grandfathering clause. How much gain will be exempt? Now, for understanding that, I have made a second table. Then I have made a third table for explaining you how much capital gain has arisen. Out of that, how much will not be taxed and how much will be taxed. And the last table is the presentation to be followed in the examination. Presentation to be followed in the examination. See, if I explain you directly the last table, now you will not understand. But once you have understood the logic, then you can just mug up the formula and find out the answer. Let us go through this first table. We have 4 cases, case 1, case 2, case 3, case 4. In all 4 cases, the date of acquisition of shares is 1st January 17. See, here we are saying that shares should be acquired on or before 31st January 18. Then only grandfathering clause is applicable to you. Why 31st January 18? Because it is one day prior to budget 2018. It is one day prior to budget 2018. So, in all these 4 cases, I have taken the date of acquisition of shares as 1st January 17. So, can I say that these dates are prior to 31st January 18? All cases, dates are prior to 31st January 18. So, in all these cases, grandfathering clause is required to be applied. In all these 4 cases, the actual cost is 100. But fair market value on 31st January 18 is different. 200, 250 and 200. And in future, you have sold these shares for 250, 150, 150 and 50 respectively. Now, let us understand the first table, grandfathering clause. In this grandfathering clause, we need to find out the amount of gain which is already earned up to 31st January 18. For that, what we should do? We should compare the cost of acquisition with the market price on 31st January 18. So, here we are taking market price on 31st January 18, which is 200, 250 and 200 in case 1, 2, 3, 4 respectively. From that, we are deducting the cost of acquisition, which is 100 in all the cases. So, in first case, my capital gain, which is already accrued or earned up to 31st January 18. In first case, second case, it is 100, 100. In third case, I don't have capital gain, I have a capital loss. In fourth case, I am having a capital gain of 100. Meaning thereby, up to 31st January 18, in case 1, case 2 and case 4, already capital gain is earned for 100. In other words, this capital gain of 100, we are keeping aside, we will not levy tax on this 100 in future. In future, whatever capital gain arises, up to 100 we will not levy tax. If the capital gain amount is in excess of 100, only that excess will be taxed at 20% by applying the provisions of section 112A. Now you refer to the second table. Second table, you calculate the capital gain by applying the same format, whatever we have discussed. Now we will discuss case by case. We will not look at all the 4 cases simultaneously. We will discuss case by case. Let us focus only on the first case. First case, you tell me what is the amount of full value of consideration? Yes? What is the amount of full value of consideration in the first case? You look at the first table. You give me the information. What is the amount of full value of consideration? It is 250. What is the amount of cost of acquisition? 100. So, what is the amount of capital gain? 150. Out of 150, how much is set aside? Because of grandfathering clause, 100 is set aside. So, on this 100, we are not going to levy any tax. So, we will levy tax on how much? we will levy tax only on 50. We will levy tax only on 50. Have you understood the first case? Yes or no? Yes? Okay. So first case we have done. Now let's move on to the second case. Second case, what is full value of consideration? Second case, full value of consideration is given here in table 1 as 150. What is the cost of acquisition? Cost of acquisition is 100. What is the capital gain? Capital gain is 50. What is the capital gain set aside because of grandfathering clause? Capital gain set aside because of grandfathering clause was 100. But your actual gain is only 50. So what we will do? We will not levy any tax. Your actual gain is 50. Capital gain set aside because of grandfathering clause is 100. So we promised you that up to 100 we will not levy tax. Your actual gain itself is up to, your actual gain itself is 100, your actual gain itself is 50. So it is within the range of 100. So we are not going to levy any tax. Have you understood the second case very clearly? Yes? Let's move on to the third case. Third case, case 3. See, this is very, very important. If the examiner has already asked question on this. He has already asked question on this twice. After 2018, twice questions are asked on grandfathering clause. Third case, your full value of consideration is 150. Full value of consideration is 150 and your cost of acquisition is 100. So your capital gain is how much? 50. Your capital gain is 50. Tell me how much you had set aside as part of grandfathering clause. Because of grandfathering clause, your amount was minus 50. In other words, you did not have a gain. Your gain was 0. In fact, you had a loss. So nothing was set aside because of grandfathering clause. Because of grandfathering clause, nothing was set aside. In other words, whatever gain arises will now be made taxable. Will now be made taxable. So this 50 will be taxed. Yes, have you understood the third case? Yes or no? Yes. Let's move on to the last case. Let us move on to the last case. Case 4, what is the full value of consideration? Full value of consideration is 50. What is the cost of acquisition? 100. So what is the capital gain? You don't have capital gain. You have a capital loss. What is the gain which was set aside because of grandfathering clause? 100. Means we promised you that we will not levy tax to you if you earn gain up to 100 in future, but actually you are not having any gain. You are having a loss. This loss, can you claim it as set off? Answer is yes. Answer is yes. This loss of 50,000, you can claim it as set off. Have you understood these 4 cases in grandfathering clause? In case 3, can't it be set off? See, Deva is asking me whether in case 3 she can set off the loss. Deva, in case 3 you are not having the loss. In case 3 where you are having the loss, you are actually having the gain. In case 3, that loss was just a amount calculated because of grandfathering. Actually you are not having the loss in case 3. In case 3 you are actually having the gain only. So you are having the loss only in the case 4. Yes? Okay. So now you have understood. See, logically you follow the capital gain format. You calculate the gain. From that gain, you deduct the gain set aside up to because of grandfathering clause. Balance will become taxable. But this format you cannot follow in the examination. This format in table number 2, table number 3, I have made you to explain you for a understanding. This format you cannot follow in the examination. This format you cannot follow in the examination. In the examination, you have to apply the formula. You have to apply the formula to calculate the cost of acquisition. In my example, I took the actual cost acquisition, but in examination, you have to apply this formula for calculation of cost. The moment you apply this formula for calculation of cost now, your capital gain amount will be directly taking into account the grandfathering clause. So what this formula is? Your cost of acquisition for computing capital gain. Normally, what is your cost of acquisition for computing capital gain is nothing but your actual cost of acquisition. So that is written here, point number 1, actual cost of acquisition. Then point number 2, they are saying you take lower of fair market value on 31st January 18. Point number 2, you take lower of fair market value on 31st January 18 compared to full value of consideration. So first point you write actual cost of acquisition. Second point you write fair market value on 31st January 18. You write full value of consideration. Out of fair market value on 31st January 18 and full value of consideration, you select the amount whichever is lower, that will become your second amount. That will become your second amount. Then you compare amount number 1 and 2, and out of 1 and 2 you select the higher amount. See, you have to mug up this formula. Logic I have already explained you. Logic by following a different approach I have explained you. But that presentation you can't follow in the examination. You have to follow the normal presentation in the examination. So in examination, cost of acquisition will be calculated as higher of following two amounts. Number 1 is actual cost of acquisition. Number 2 is lower of FMV on 31st January 18 and FVOC. By following this formula, you will get certain cost. That cost you should deduct from full value of consideration. If you do this, the amount of gain which you will get now, that will be directly gain after deducting the grandfathering gain. So instead of two tables, you have to just calculate capital gain in one format itself. Now let us go through this case by case. Let us go through this presentation case by case. Let us focus only on the one case at a time. Case 1, can you tell me what is your full value of consideration? 250. Full value of consideration is 250. Now you get me the cost of acquisition by applying that formula. By applying that formula, you get me the cost of acquisition. What is point number 1? Point number 1 is actual cost of acquisition. Point number 1 is actual cost of acquisition. How much is that? 100. So your actual cost of acquisition is 100. Second point is what? Lower of FMV or FVOC. What is FMV? 200. What is FVOC? 250. What is lower? 200 is lower. So your amount number 2 is 200. Now you select amount number 1 or 2, whichever is higher. So amount number 1 is 100, amount number 2 is 200. You select whichever is higher, that is 200. That will be taken as your cost of acquisition. From full value of consideration of 250, you deduct the cost of acquisition of 200, your capital gain is 50. See, now directly you have arrived at an amount of capital gain which is after giving the effect of grandfathering clause. Directly you are arriving at that amount by applying this formula. Have you understood this? Yes? Case 1 we have done. Case 2. What is full value of consideration? 150. From that I need to deduct the cost of acquisition for computing capital gain. That cost of acquisition will be point number 1, actual cost of acquisition, which is 100. Point number 2, lower of FMV and FVOC. FMV is 200, FVOC is 150, lower is 150. Lower is 150. Now I should take higher of actual cost or amount number 2. That is higher of 100 and 150. I will take 150. I will deduct this 150 from my full value of consideration. The balance amount of gain is 0. See this. In the previous table itself, you are getting the same amounts. Presentation, you have to follow this presentation for the examination that I have clearly written here. Case 3. Case 3, get me the amount of full value of consideration, 150. From that, I should deduct the cost. First, I should take the actual cost. What is actual cost? 100. Second, I should take lower of FMV and FVOC. What is FMV? 50. What is FEOC? 150. I should select what? Whatever is lower. So I have selected 50. That will become my amount number 2. Amount number 1 is 100. Amount number 2 is 50. I need to select whichever is higher. So I have selected 100. That 100 will be deducted considering it as cost acquisition. So my gain is 50. This gain is matching with the previous table. Lastly, we want to case number 4. See, I have tried to explain you the logic why grandfathering clause was inserted, when it was inserted, section 112A was introduced when, why it was introduced. All those things I have explained you, but at the end of the day, you mug up this formula, that's all. And you give the answer as per this. Let's move on to case 4. Get me the amount of full value of consideration. It is 50. What is the amount of cost acquisition? First of all, I will take actual cost acquisition. This is 100. Second amount, I will take FMV on 31st January 18 or FEOC, whichever is lower. So FMV is 200, FEOC is 50, whichever is lower is 50. That 50 will become my second amount. Now I should select amount 1, amount 2, whichever is higher. So I have selected 100 as higher. I will deduct 100. So I arrive at the amount of long-term loss as 50. This is matching with my previous table. So you have to follow this last table for the purpose of presentation. You have to follow this last table for the purpose of presentation. You can mark this as very important. This is an exhaustive discussion of grandfathering clause. You can pick up the CA final module and solve the Kaplan questions. I am very much confident that you will be able to solve. Now let us refer to section 112A in detail. Section 112A, as I said you already, it was introduced in budget 2018 to remove the exemption and levy the tax. But the tax was levied at a concessional rate of 10% subject to fulfillment of certain conditions. So point number 1 says concessional rate of tax in respect of long-term capital gain on transfer of certain assets. Plus, you will not get any indexation. Plus, long-term capital gain only in excess of 1 lakh will become taxable. Long-term capital gain only in excess of 1 lakh will become taxable. Conditions. Now, this I am not reading it once again. This is same. Already covered in that flowchart. Long-term capital gain is arising on transfer of equity shares or units of equity or into mutual fund or units of business trust. Sale transaction is done through stock exchange. STT is paid. Or long-term capital gain has arisen on transfer of on a transaction undertaken in an international financial service center on which STT is not paid. The same thing is written here. Point 3, I have not explained. Adjustment of unexhausted basic exemption limit, I have not explained. I need to explain you this. I will take an example to make you understand. Chapter 6 deduction is not available. Point number 4, that is also I have not explained you. Point number 6, I already explained you. Point number 6, I have explained you. If the shares are acquired on or before 31st January 18, then only grandfathering clause is applicable. If grandfathering clause is applicable, you apply that formula for calculating the cost of acquisition and accordingly you calculate the capital gain. If the shares are acquired on or after 1st February 18, what is 1st February 18? The date on which the budget 18 was given. So on or after 1st February 18, your cost of acquisition will be nothing but the actual cost of acquisition. Point number 5, let me tell you right now only. No benefit of rebate will be available under section 87A against the long-term capital gain which has arisen in section 112A. Do you remember what is section 87A? Section 87A was covered in the chapter of basic concept. Section 87A, rebate under section 87A is lower of following two amounts. Number 1, what is that? 100% of tax liability excluding education cess. Number 2, 12,500, whichever is lower. For claiming rebate under section 87A, 3 conditions are required to be fulfilled. Number 1, SSC should be individual. Number 2, SSC should be resident. and number 3 is total income should be less than equal to 5 lakhs. In that case, rebate under section 87A will be lower of following two amounts. 100% of tax liability excluding education cess. So rebate should be deducted before adding health and education cess. Compared to the amount of 12,500, maximum rebate will be 12,500 rupees. We have already solved one practical question on a rebate in chapter number 1. Now, I am telling you that this rebate will not be available against section 112A. For example, if you don't have any other income, listen to me carefully. Dikshit, government doesn't want to give you the rebate. Intention of the government is to levy tax on the capital gain. Intention of the government is levy tax on the capital gain. Rebate was given with an intention to help those people who are into middle class category and whose total income is less than equal to 5 lakhs. Those people who are into lower middle class category, first of all, they will not have capital gain only. They will not have that much amount of money to invest in shares. So government is of the opinion that you are having that much amount of money that you have invested in shares, you have huge amount of capital gain also, that too more than 1 lakh. Why should we offer you rebate? Yes? So government says no rebate. Now listen to me carefully. For example, you are not having any income. You are only having long-term capital gain which is covered by section 112A, and the amount of that long-term capital gain is 5 lakhs. You are not having any income. You are having only one income, long-term capital gain, which is covered by section 112A. So that long-term capital gain, you will not be eligible to claim rebate under section 87A. Even if you are a resident person, even if you are individual, even if your total income is less than equal to 5 lakhs, you will not get any rebate under section 87A. Is that very, very clear? Now I need to explain you point number 3 and 4. For that, this entire flow chart of tax rate is summarized here. I am going to take an example to make you understand. I will be taking up a numerical example here. Also, I would be writing something. See, these are all complex situations. CA Institute had asked MCQs based on this complex situation in the examination November 2020. Lot of students told me that they were not in a position to solve the MCQs within a span of 1.5–2 minutes. Such kind of MCQs now, they will consume time, and if you don't have clarity with respect to the provisions, 100% you will not get the answer. See, solving the MCQs in a span of 1.5–2 minutes is a very big challenge when it comes to calculation of tax liability, take into account all these special provisions. So, I have explained you all these provisions today. I am still explaining. I am going to take example to make you understand different situations. I can't go on solving 50 questions. It is not possible. Therefore, I am taking the numbers and making you understand different provisions. If you revise all these things properly, then only you will be in a position to solve the MCQs. And believe me, out of 30% marks, income tax subject is 60 marks. Out of that 30% marks, that is 18 marks is MCQs. Out of 18 MCQs, if at all they decide to ask you 18 MCQs of 1 marks each, then all those MCQs which are based on tax liability, they would cover all these complicated points. And if you have not revised the provision day before examination, believe me, you will not get the answer. If at all you get, you will consume 10–15 minutes time. The MCQ 15 minutes time, we should be solving 6–7 MCQs at least. One MCQ will consume that much time. So, ideally, you should revise the tax rates, special rates, everything day before examination. If at all you are unable to revise and you feel that this is going to take a lot of time, skip that MCQ. Simple. Don't waste your time. Don't run behind that 1 mark. You have remaining 99 marks. So that is what you have to do in the examination. The moment you realize that this thing is consuming a lot of time or it is going to consume a lot of time, skip that question. One question here and there, you are not going to fail. You need to make your strategy 15 minutes before the examination time. You are going to get the question paper. So in that 15 minutes, you have to plan, you have to decide, make the judgment which question appears to be difficult for you. So skip that question. That is what you have to do 15 minutes, whenever 15 minutes before the examination when you get the question paper. In an examination, you should keep a timer in front of you. Examination, you should keep a watch in front of you. The 100 marks paper, you are given 180 minutes. So 1 mark, you should devote maximum 1.8 minutes. So if it is a 5 marks question, 5 multiplied by 1.8, that is 9 minutes. You cannot devote more than 9 minutes. If you have already given 12 minutes, skip that question. If you feel that you will not be in a position to do within next 30 seconds or 1 minute, skip that. Because if you run behind the compulsory question, you are gone. CA Institute November 20 examination, compulsory question was very much difficult. People who started with compulsory question, they went on solving the question and at the end also they did not get the correct answer. More than 1 hour was consumed in that compulsory question itself. The moment you run behind a question like a mad person, you are gone. You have to look at the timer. Time is very, very important. Time management, if you don't do, you are gone. So now I am moving on to these tax rates once again. I am just summarizing the things and making you understand only 2 points. So here I have divided income into 2 parts. Here I have divided the income into 2 parts. Income taxable at fixed rate and income taxable at slab rate. See, this discussion is from the point of view of resident individual, resident HUF. Not from the point of view of company, firm, etc. This discussion is only from the point of view of resident individual and resident HUF. See, resident individual HUF, income will be broken down into 2 parts for the purpose of calculation of tax liability. For the purpose of calculation of tax liability, this income is bifurcated in 2 parts. Income taxable at fixed rate, income taxable at slab rate. Long-term capital gain covered by section 112 is taxable at what rate? 20%. But in certain cases, in case of listed securities, etc., you also get an option of 20% with indexation, 10% without indexation. Short-term capital gain covered by section 111A is taxable at flat rate of 15%. Long-term capital gain covered by section 112A is taxable at 10%. Definitely this long-term capital gain you have to calculate without applying the benefit of indexation. So these are the tax rates. Winning from lottery, crossword puzzle, etc. is taxable at 30%. This is not covered. This will be covered in the chapter of income from other sources. So winning from lottery, winning from KBC, all these things, any TV serial game show, if you win something, that would be taxable at flat rate of 30%. That would be covered in the chapter of income from other sources. The section is section 115BB. That we'll discuss in IFRS, not now. So here I have taken on the left hand side 4 incomes which are taxable at flat rate. See, whatever discussion I am doing right now, is very, very important discussion. When I move on to the chapter of deductions, I am not going to repeat this. And this will be very important for you to solve the question of computation of total income and tax liability. In the examination, the first question which you get, compulsory question, would definitely have such kind of complications. So it is very important discussion. I am going to take exhaustive examples to make you understand, but focus here. So we have 4 income which are on the left hand side. These incomes are taxable at flat rate, fixed rate of tax. All other incomes would be taxable at slab rate. What all other incomes will be included in the right hand side? Income from salary, income from house property, income from business profession, income from short-term capital gain which is not covered by section 111A, and income from other sources other than winnings. See what all will appear on the right hand side. Once again I am repeating for you. Income from salary, income from house property, income from business profession, income from short term gain other than section 111A short term gain, and income from other sources other than winnings. These things will be covered by right hand side. This income will be taxable at slab rates. Slab rate means up to 2,50,000 no tax, up from 2,50,000 to 5 lakh, 5% tax above 5 lakh, up to 10 lakh, 20% tax above 10 lakh, 30% tax. Now very important point number 1, listen to me carefully, very important point number 1, chapter 6A deduction. Do you remember chapter 6A deduction? Starting from section 80C to 80U. I have not taught that to you, but in the chapter of basic concept we had discussed that from the gross total income you go on, you deduct chapter 6 deduction to arrive at the amount of total income. Sarvana, I have not taught you chapter 6 deduction chapter. That will start after we complete 5 heads of income, but in the basic concept chapter we discussed the format for computation of total income na. Format for computation of total income was discussed with you in the chapter of basic concept. Page number 11 in your textbook. Page number 11 in your textbook. Yes? If you want, you can see that. Page number 11 in your textbook. Once you calculate 5 heads of income, you add all those 5 heads of income, you get the amount of gross total income. From that gross total income, you claim chapter 6 deduction. Those are from section 80C to 80U. You have to just remember, everything will be discussed in deduction chapter. The moment you deduct chapter 6 deduction, the balance amount of income is nothing but your taxable income or net taxable income. So I am giving you 2 important points. This will be repeated in deduction chapter, but will not be explained. See, repeating and explaining are 2 different things. This entire flow chart I have also given you in the deduction chapter. When we move on to deduction chapter, once again I will repeat this. I will not re-explain, I will repeat. So I am telling you, this chapter 6A deductions are not available against income which are taxable at fixed rate. Against those income which are taxable at fixed rate above 4 points, against that you cannot claim chapter 6A deduction. Chapter 6A deductions cannot be claimed against these incomes. So if your total income includes this special incomes taxable at flat rate, you have to segregate that income, you have to remove that income from your total income. And you can claim chapter 6 deduction only against the balance income which is taxable at slab rate. So here I have written chapter 6 deductions are available only against income taxable at slab rate. Chapter 6 deductions are available only against the income which is taxable at slab rate. So this is the first important point. This is the first important point. Now, before I move on to explain you another important point, this is an example in front of you. In this example, you are having an income from house property. You are having income from house property. How much? 6 lakhs. You are having long-term capital gain on equity shares. These are sold through stock exchange. Securities transaction tax is paid. So tax rate on this long-term capital gain will be at the rate of 10% in excess of 1 lakh. This capital gain is 4 lakhs. You don't have any other income. So what is your gross total income? 10 lakhs. Your gross total income is 10 lakhs. Now you tell me, out of 10 lakhs, against how much income you can claim chapter 6 deduction? Against this 4 lakh, you can't claim chapter 6 deduction. Against this 4 lakh, you can't claim chapter 6 deduction, means you can claim chapter 6 deduction only against 6 lakhs. You can claim chapter 6 deduction only against 6 lakhs. See, I am sharing this presentation with you. This presentation you will not find in ICI module. You will not even find in any other book of any other author. This presentation is exclusively made by me to ensure that you don't do the mistake in the examination. Now at the end you will be asking me why should I do this much presentation to ensure that you don't do the mistake. What is that now? We'll cover here. Listen to me carefully. Now we have concluded that chapter 6A deduction is available only against income which is taxable at slab rate. So out of 10 lakhs, chapter 6A deduction is available only against the income of 6 lakhs. In other words, it is not available on the income of 4 lakhs. So first of all, if you come across any income, which is taxable at flat rate, those income you should deduct from your gross total income. So what I am deducting from my gross total income? See, everything which is highlighted in yellow is important. So I am deducting long-term capital gain. Covered by section 112A. Because this is taxable at flat rate of 10%. I am deducting long-term capital gain covered by 112. This is taxable at flat rate of 20%. I am deducting short-term capital gain covered by 111A. This is taxable at flat rate of 15%. I am deducting winning. This is taxable at flat rate of 30%. All these fixed rate income I should deduct. Dikshit. Right now we are not calculating the tax liability. Very important doubt you have asked. I am sharing this doubt which Dikshit has asked me. Listen to me carefully. Dikshit says that in section 112A, you said that long-term capital gain in excess of 1 lakh is taxable at 10%, na? Then why you are taking the long-term capital gain of entire 4 lakh here? You should take only 3 lakhs. That is what he is asking. This is very important question. I do not know whether others have understood the question or not. Have you understood the question which Dikshit has asked? He says that the long-term capital gain covered by 112A is taxable in excess of 1 lakh. So, right now the long-term capital gain is 4 lakh na. You remove 1 lakh and you take only 3 lakhs. So, listen to me, very important. This is very important doubt and I am answering this doubt. You can mark this point as very important. Section 112A is not applicable for calculating the income. Section 112A is not applicable for calculating the income. Section 112A is applicable for calculation of tax liability. In other words, when you calculate the tax liability, only at that point of time you should remove 1 lakh. While you calculate your income, you should not remove 1 lakh. You should take the entire amount of capital gain, because right now your purpose is to calculate the total income. When you move on to calculate the tax liability, at that point of time you should remove 1 lakh. That will cover. See here below we have calculated the tax liability. At that point of time I have removed 1 lakh here. So that 1 lakh should not be removed while calculating total income. It should be removed only while calculating the tax liability. So once again I am coming back to that point. From the gross total income, I am deducting all those income which are taxable at fixed rate. So I am knowing that 4 incomes are taxable at fixed rate. Now, the moment you come across fixed rate income in the question, you should deduct from your gross total income. So in my current question, I am having only one income which is taxable at flat rate, that is covered by section 112A, and that is 4 lakh. I am deducting that. So I have arrived at the amount of 6 lakhs. What is this 6 lakhs? This is the income which is taxable at slab rate. This is the income which is taxable at slab rate. Only against this income I can claim chapter 6A deduction. Now say for example, you have calculated your chapter 6A deduction from section 80C to 80U, and your chapter 6A deduction actual investment is 7 lakhs. Question is, can you claim deduction for 7 lakhs? Answer is no, because chapter 6A deduction can be claimed only against those incomes which are taxable at slab rate. What is your income taxable at slab rate in this question? Is only 6 lakhs. So, if your actual investment in chapter 6A is more than 6 lakhs, your deduction will be restricted to 6 lakhs. Now the point is, if you don't deduct this fixed rate income, then orally in your mind you have to do the calculation. In your mind orally you will have to do the calculation that my income is 10 lakhs, out of 10 lakh, the slab rate of fixed rate income is 4 lakh, so slab rate income is 6 lakhs and my chapter 6 reduction is 7 lakhs. So my chapter 6 reduction should be restricted to 6 lakhs. This kind of calculation you have to do in your mind. If you forget to do this now, then your final answer will be wrong. So to avoid doing this calculation in your mind, because you tend to forget this, to avoid this, I have made the presentation in such a manner that you will not do mistake. Because in this presentation, your slab rate income will appear in front of you, 6 lakhs. And your chapter 6 reduction, the moment it is more than 6 lakhs, you will automatically restrict that deduction to 6 lakhs. And the moment you deduct this 6 lakhs, your income taxable at slab rate after chapter 6 reduction is 0 in this case. Now what I will do, whatever fixed rate income I had deducted above, that I will be adding it back to my balance income. So I am adding this 4 lakhs. The moment I add this fixed rate income, I would arrive at the amount of total income. Now, some of you might think, if you are adding this 4 lakh, then why you deducted? Because if you deduct and add back, you are getting the same amount now. Don't deduct and don't add. What is the purpose of deducting and adding? Tell me, what is the purpose? If you don't deduct, then it may happen that by mistake you will claim chapter 6 deduction even against the income which is taxable and fixed rate. That is the reason we have made this presentation. See, if you don't do such kind of presentation, in that case you will take the gross total income to be 10 lakhs. And by mistake, if you claim the entire chapter 6 reduction of 7 lakhs against the income of 10 lakhs, then your total income will be 3 lakhs, which is wrong. Your total income is not 3 lakhs, it is 4 lakhs. That is the reason I have made that presentation. If you can remember and do the calculation in your mind, saying that what is the amount of fixed rate income, what is the amount of slab rate income, then don't do such kind of presentation. But I have seen that most of the people will forget. That is the reason I have made such kind of presentation. Now you have arrived at the amount of total income. Now on this you have to calculate the tax liability. Dikshit, now we are on the calculation of tax liability part. Till now we were doing the calculation of income only. So now we are on the calculation of tax liability part. Tell me what is the amount of your total income? 4 lakhs. Total income is 4 lakhs. Now this income, part of the income can be taxed at slab rate, part of the income can be taxed at flat rate. What is the income taxable at fixed rate here? And what is the income taxable at slab rate? In fact, your entire slab rate income is exhausted against chapter 6 reduction. Your entire slab rate income is exhausted against chapter 6 reduction. So your slab rate income is 0. Your slab rate income is 0. The entire of total income is fixed rate income only. And this would be taxed at 10%. Now listen to me very carefully. What is the basic exemption limit which government is offering you? What is the basic exemption limit which government is offering you? 2,50,000. This basic exemption limit is available against the slab rate income. This basic exemption limit is available against the slab rate income. What is the slab rate income? In this example, it is 0. In this example, your slab rate income is 0. So, tell me, did you get the advantage of basic exemption limit? Did you get the advantage of basic exemption limit? No, because you don't have the income only. So, in that case, we say that your entire basic exemption limit is unexhausted. Your entire basic exemption limit is unexhausted. So, we have the unexhausted basic exemption limit of 2,50,000. We have the unexhausted basic exemption limit of 2,50,000. This unexhausted basic exemption limit, first of all, tell me, have you understood unexhausted basic exemption limit? What is unexhausted basic exemption limit? Have you understood? Yes or no? Yes. Okay. Let me get into that page number in your book. I am going back to page number 215. Whatever I have explained you till now, I am just reading in this flow chart. See what it says. If chapter 6A deduction is greater than income taxable at slab rate, then your chapter 6A deduction will be restricted to the amount of income taxable at slab rate. What is the amount of chapter 6A deduction here? 7 lakhs. What is the amount of income taxable at slab rate? 6 lakhs. So what we have done? We have restricted your chapter 6A deduction up to the amount of income which is taxable at slab rate. So chapter 6A deduction will be restricted to the amount of income which is taxable at slab rate. This I have already explained you. Now further table says, if income taxable at slab rate after chapter 6A deduction. What is our example? In our example, what is the amount of income taxable at slab rate after chapter 6A deduction? My income taxable at slab rate before chapter 6A deduction was 6 lakhs. Entire 6 lakhs I claimed chapter 6 deduction. So my income taxable at slab rate after chapter 6 deduction is not 4 lakhs. My income taxable at slab rate after chapter 6 deduction is 0. See this. My income taxable at slab rate after chapter 6 deduction is 0. So if my income taxable at slab rate after chapter 6 deduction is less than the basic exemption limit, if my income taxable at slab rate, which income taxable at slab rate, that too after claiming chapter 6 deduction, in this example it is 0. Is that less than the basic exemption limit? Yes, it is less than the basic exemption limit. In that case, you have to calculate unexhausted basic exemption limit. You have to calculate unexhausted basic exemption limit. How do you calculate unexhausted basic exemption limit? You write the amount of basic exemption limit. From that, you deduct income taxable at slab rate after chapter 6 deduction. In our example, basic exemption limit is 2,50,000 and the income taxable at slab rate after chapter 6 deduction is how much? 0. So what is the amount of unexhausted basic exemption limit? 2,50,000 in our case. In our case it is 2,50,000. Such unexhausted basic exemption limit can be adjusted against long-term capital gain. Which long-term capital gain? 112 as well as 112A. This unexhausted basic exemption limit can be set off, can be adjusted against long-term capital gain covered in 112 as well as 112A. It can also be adjusted against section 111A short-term capital gain, but such an exhausted basic exemption limit cannot be adjusted against winnings. So, if you get some unexhausted basic exemption limit, you can adjust this first income, second income, third income. You cannot set off the fourth income. Now, point is, out of this first three income, which one you should adjust first? Which one you should set off first? Whatever is unexhausted basic exemption limit can be set off against your income taxable at fixed rate. It can be set off against first, second and third income. Question is, which income we should set off first? The income which is having a higher tax rate should be set off first. Income which is having a higher tax rate should be set off first. So long-term capital gain covered by 112, we will set off first. Thereafter, if you have unexhausted basic exemption limit, then we will set off short-term capital gain covered by 111A. Thereafter also, if you have unexhausted basic exemption limit, 112A long-term capital gain will be set off. Thereafter also, if some unexhausted basic exemption limit is left, that will lapse. That will lapse. You cannot set off winnings. Setting off the winnings against the income, setting off the winning against the unexhausted basic exemption limit is not allowed. Now, whatever I read right now, you apply in this question. In this question, your income is how much? Total income? 4 lakhs. Out of total income, how much is taxable at slab rate? 0. So what is the basic exemption limit? 2,50,000. Out of 2,50,000, how much you utilized? 0. So what is unexhausted? 2,50,000. Can you adjust this unexhausted against long-term capital gain, short-term capital gain? Yes. So your 4 lakh long-term capital gain, I will first of all, up to 1 lakh there is no tax. Up to 1 lakh there is no tax. Dikshit? Dikshit? Out of 4 lakh, up to 1 lakh there is no tax. And this 2,50,000 unexhausted basic exemption limit I will be adjusting here. So from 4 lakh, how much is already gone? 3,50,000 is gone. So what is left? 50,000 is left. This 50,000 will be taxable at flat rate. As per section 112, this will be taxable at what rate? Flat rate of 10%. So 10% of 50,000 is 5,000 rupees. On that you apply 4% says that is 200 and the tax liability will be 5,200. Your tax liability will be 5,200. Is that very, very clear? Okay. Thank you very much. Bye-bye.